In Santa Rosa for our April 3rd meeting. Welcome to everyone who's in the room with us, as well as everyone who's attending on webcast. One of our commissioners is running a few minutes late, but we're going to get started and he'll be joining us shortly. With that, let's do the call to order. Commissioner Khan? Here. Commissioner Wara? Here. Commissioner Jones? Commissioner Nava? Commissioner Jones will be joining us in a few minutes, and Commissioner Nava had an unavoidable delay, and so he will not be joining this meeting, but he will be following our webcast. And thanks you all for attending today's forum. We are also joined by our Executive Officer, Evan Johnson, who's sitting here to my left. For everyone in the room, if you're just a couple of logistics, we're right near the entrance. As you came in, that will be your exit in case of emergency. If you need the restroom facilities, they're over here to the right, outside of the door to the right. With that, let me call to see if there's any changes to the agenda. Commissioners, any agenda changes? I have none as well. So can I get a motion? Sorry, I'm mixing up my issues. I do have an agenda change or announcement. Supervisor Gorin will be joining our panel 8C, Community Needs Around Wildfire Damages, and we look forward to her participation. Any other agenda changes, Executive Officer? So now is the opportunity for our first session of public comment. Thank you. What would I do without you? I'd like to welcome up Supervisor Gorin to the microphone, who will be giving us a welcome to your community. Welcome, Supervisor, and thank you so much for allowing us to use your lovely facilities.
I'm usually sitting on that side of the room and not this side. So indeed, we have a button to raise and lower the lectern. Commissioners, thank you so much for being here this morning and agreeing to participate in this discussion and hear from our community. As you know, we've experienced significant damage from the 2017 wildfires. And sadly, I'm one of the families who lost their homes in the fires. We have. Oh, come on. Yeah. Thank you, Mike. Appreciate that. We'll turn the mic on. Thank you so much for being here. We have lessons to share with you, both personally and professionally, as we have reorganized the county to actually appoint a number of team members to move us forward on recovery and resiliency. I'll have some more comments later on in the program, but I want you to know that the now trite statement, this is a marathon and not a sprint, is ever so important to Santa Rosa and Sonoma County. I am one of the homeowners who have yet to move forward with rebuilding. Over half of the homes lost are not yet in some process of rebuilding. Our community is energized and looking forward to working with you, and we need your leadership to take our messages and our lessons to Sacramento so that we can be part of the collaboration working together to prepare towards resiliency in the future. Thank you so much.
Thank you. Thank you, Supervisor. Now's the time for general comment. We do have time for public comment at the end of the session, and if you can stay for the day, we encourage you to make your comments then. That we appreciate those, that folks have other things to do, and so if anyone needs to make comments now, we welcome you. I have 2 cards that we have identified for the morning session. If you have any other public speakers, please provide your cards on the left. So first, welcome Russell Mills from SMUD. And Mr. Mills will be followed by Jeff Okerke.
Greetings, members of the commission and the public.
Sir, can you make sure you're using your microphone? Is it on? Can you speak into it?
Is this on?
Okay.
Sounds great.
Much better. Greetings, members of the commission and the public. I'm Russell Mills, Treasurer and Director of Risk Management for the Sacramento Municipal Utilities District. For SMUD, we have a service territory in and around the state capitol. Today I wanted to provide a few comments on the insurance market dislocation and the increased POU risk profile, along with considerations for a wildfire fund solution. Due to the inverse condemnation and strict liability, California wildfire insurance markets are not functioning. Insurers have no choice but to price risk and coverage much higher than was normally required or exit the market. Utilities are having difficulties obtaining and maintaining coverage at a reasonable cost. And recently, bond ratings agencies have started reassessing POU's financial risk to wildfire catastrophes and responsibility of claims. Bond ratings are a significant driver for utility capital costs and are vital to maintain access to credit markets. Ratings reflect financial risk for the utility to meet financial obligations, considering all their potential risks, and low ratings result in higher borrowing costs. Ratings have been placed on negative watch as a precursor for downgrading ratings absent any structural risk changes for the largest POUs in California. The largest southern POU last month was revised to negative watch, and then just yesterday, SMUD was also revised to negative watch by Moody's. Moody's cites that view that the utility operating environment in California has become more challenging as legislators and other policymakers look for viable alternatives involving the application of inverse condemnation while simultaneously balancing the potential impact on municipal utilities and ratepayers. So credit markets, while not completely dislocated for the POUs, it is largely becoming an issue that they are taking notice of. So down the line, it could affect the POUs as it has the IOUs. Some considerations for a wildfire fund. It should result in real financial benefits and increased risk coverage for POUs and the ratepayers. If a fund is established, POU participation in a fund could be on an opt-in basis, or if mandatory, it would be most equitable if all California ratepayers were required to participate. It should be structured to work as a supplement to existing insurance and self-funding liquidity measures, including proper attachment points that will incentivize the utility to provide their ratepayers with adequate and cost-effective insurance coverage. A catastrophic wildfire fund must be more than just a pooling of shared ratepayer funds. It must offer a form of increased insurance coverage for POUs that they would not otherwise be able to obtain in the market. And should help California return to a more normal functioning insurance market by making available alternative catastrophic funding mechanisms over the longer term. Attachment points will help with pricing for underwriters. Any fund with POU participation should be held in some sort of a trust, such that the funds could not be repurposed for other uses in the future. A true lockbox fund with clearly defined funding, withdrawal, replenishment, and fund segregation guidelines. In a single fund with unclear segregation of funds, POU, IOU cross-subsidization could result in use of public funds to pay for private uses. This could result in issues for POUs maintaining their tax-exempt status. So we would need to be consulting tax counsel and how this could work for a POU. The state must also consider how funds will be replenished once drawn. Is there an implicit state funding backing with this fund? Should include protections that ensure one utility with significant claims cannot drain the fund or make it in any other way insolvent for use by other electric utilities, straining the costs incurred to pre-fund and subsequent funding contributed. Contributions should account for participating utilities, relative wildfire risk profiles, number of customers, among other factors. A one-size-fits-all approach may not work and could unfairly shift cost burdens from IOUs to other smaller utilities. The fund must be appropriately structured to be sustainable over multiple years, meaning it can withstand multiple years of high-cost catastrophic wildfires. So in closing, this is a severe issue affecting the entire state. The insurance markets are no longer functioning. Credit markets are beginning to show signs of potential future pressures for all of the POUs, including SMUD and any of the smaller utilities. Viable alternatives for funding are needed, but need to be structured fairly and recognize each utility has different risk profiles and funding needs. Thank you.
Mr. Mills, would you mind staying just for 1 minute for questions? And I'm also going to ask that you submit your written comments to the commission at some point, your executive officer.
Absolutely.
Mr. Mills, if we have, if the state creates a fund, there'll be a governance issue. And if the fund includes IOUs and POUs, I assume that you're suggesting that there'll be one governance structure over the IOUs and POUs for the purpose of the fund. Is that right?
Yes.
Do you think that the state is going to need to consolidate the wildfire plan oversight along with the fund? Because we've had recommendations from a number of the IOUs that they worry about the fund and prudency issues and whether you disqualify from some benefits of the fund if you don't follow your wildfire plan. You follow me? So my question is, I don't know how a fund that consolidates IOUs and POUs functions unless that same fund or governance also governs the wildfire plans. Can you explain that to me?
Yeah, I would think that in order for the governance structure to actually function correctly, consistency, it matters, and all utilities should be held to the same standard in following the wildfire plans.
So I just want to be clear. What you're suggesting is the creation of a wildfire fund that includes POUs and IOUs that has a consolidated governance, and the governance governs not only this large fund, but also governs the wildfire mitigation plans of all the utilities.
I think that it could be structured that way. I certainly think the funding mechanism is very important to have in place. But the only way to access the funding may be to make sure that the wildfire plans are followed and mitigation efforts are actually put in place that are actually published in these wildfire plans.
I'm sure that we and the governor and legislature would be curious how you would do it otherwise. If you have an idea of how to disaggregate that, otherwise it seems to me that the suggestion is that you're consolidating.
Right, yeah, I actually think that a consolidated fund, it probably works for statewide participation, but I think that there needs to be some form of opting in if it's not mandatory for everyone to participate.
Well, I don't see how does it work if it's not mandatory?
And Commissioners, may I suggest, we're going to be deep diving into this topic later today. Mr. Mills, will you be around?
I will. I actually hadn't thought to speak towards the end, but I will certainly come back if you have questions.
Well, we might want your input then. And then also, we're going to have an opportunity for stakeholders to provide us detailed written comments or recommendations. And so in particular, some of your feedback on some of the details of the fund would be appreciated, including Commissioner Khan's questions around voluntary or mandatory. Thank you so much. And our next morning comment is from Jeff Oakland. Welcome, and please correct your name if I said it incorrectly. And that's anyone else whose name I call. Welcome.
Good morning, Madam Chair, as well as fellow commissioners. My name is Jeff Krupke. I am a once and future resident of Coffee Park here in Santa Rosa. I also happen to be the founder and president of Coffee Strong, an organization that was started in the aftermath of the 2017 Tubbs fire to help rebuild our community as efficiently as possible while minimizing any hurdles in the way for all of our residents. The reason why I felt the need to speak this morning is because I'm looking at your agenda. You have a large section on homeowners insurance. However, 40% of Sonoma County are renters. And statistically speaking, and Commissioner Jones knows this, that roughly 25 to 30% of renters carry renters insurance. In looking at the legislative slate last year, exactly one bill of all of the bills passed, including all the insurance bills, affect renters. This is important because if you're doing the math, that's about 20% of homes that burnt to the ground, single-family detached homes, not just apartments that burnt to the ground, that had no coverage at all whatsoever. This is important because it's not just an insurance matter, but it's a cultural matter in neighborhoods. A lot of these homes that are being rebuilt over investment properties were sold because it doesn't necessarily pencil to wait to build an investment property that you rent out. So they're sold as investors that intend on flipping those homes and reselling them. In Coffee Park alone, we estimate losing about half or more of the properties that were once renters to homeownership. This is important because not only does homeownership, not only do renters culturally impact the neighborhood, but they're also important for the economic state of the city. They are your service employees, your hospitality employees, agricultural employees, and if we lose renters, we lose the ability to lure young professionals, young families to this area to help the economic vitality. It's also important to note that the legislative slate that was passed did nothing for renters because the fundamental concept of insurance, especially in disasters, is the recovery and replacement of property and not other aspects like quality of life. So when you look at it, it's a scenario where there are studies from Harvard and other places that say in a natural disaster, homeowners actually gain wealth versus renters who lose wealth. And if you're a minority, it is exponentially worse. And this is important because when you look at a natural disaster and you have 5,000 homes that burn, in a regular scenario, in a single-family detached home, it burns to the ground. If you rent, you can theoretically go and find another place to rent. But when that market, that rental market is flooded by 5,000 people looking for a place to live, VRBOs coming off the market, they can now rent out at 125% of HUD, which in this area for 3.2 is about $4,000. The renters are automatically priced out, especially when insurance companies are willing to pay ALE for homeowners to move in there. So my ask of you today is to take a look at renters insurance, the ability for renters to maintain their life and stay in these communities because it's important. Thank you.
Thank you. Now we will turn to approval of the consent calendar. We have one item on the consent calendar, which are the minutes from the March 13th, 2019 meeting. Commissioners, any changes to the minutes? Hearing none, can I get a motion? Don't jump at once. Second? Second. All those in favor say aye.
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 All right. So I will do a very brief chair's report. Again, I just want to welcome you to our meeting. This is the third of 4 public meetings we're having around the state. By way of background, our commission was created by legislation last year to assess, analyze, and make recommendations on how we can more equitably allocate and manage the costs associated with catastrophic wildfires. We are required to give recommendations to the legislature by July 1st, and everyone on the commission comes with different expertise. And I thank all my fellow commissioners for volunteering their time to serve on this important commission. For further background about the commission and the topics we've talked about so far, I'll refer you to our website, which is opr.ca.gov/wildfire. That's also where you can see all the public comments we have and hear information about future meetings. Our executive officer will be talking to you about specific comments we'd like to receive in written format over the next few weeks. We always welcome written comments at any time, but in particular, as we plan for our 4th meeting, where we'll be focusing more on specific recommendations and proposals, we'd like to hear from all of you in advance regarding any specific proposals, as well as any reflections you have on the first 3 meetings. He'll be speaking more to the timing of those comments, and if you join our service list, you'll get that specific notice. With that, I have no further comments. I'll just turn to my fellow commissioners. Does anyone else have any introductory comments they'd like to make at this time? I will note also that we have a tight agenda today. This room turns over for other important county business at 2 o'clock. We're going to try to cover a lot, but I appreciate your patience and indulgence as I monitor the clock and keep us moving. Thank you. Executive Officer?
Thank you, Chair. Just a few quick comments. First, as you mentioned, we will be, following this meeting, we will be putting out through the listserv a request for a specific request for public comments with questions we'd like addressed in those public comments, and there'll be a pretty quick turnaround. The details will come in that notice, but we're looking for likely an April 15th turnaround for those particular comments. As I said, that will be more details will be in the notice. But please, if you haven't joined the listserv, please do, because we'll be sending that out by the end of the week here. In addition, I did want to take a minute to announce that we're going to have our next meeting April 29th in Oxnard. Again, more details will be on the listserv, so please join that and you'll receive notification of the location and timing of that meeting. And I think that's it for me.
Great. And on the note, if you respond to the questions, you don't have to respond to every question, just respond to the questions that are most relevant to you. We're looking to get as much information as possible, cast as wide a net as we then focus down in actual recommendations. So with that, today we're going to be focusing on homeowner insurance markets as well as broader financing mechanisms for managing these liabilities and costs. So let me invite our first panel up. Thinking logistically, we're going to have everyone sit
Yeah,
here.
everybody can sit.
So everyone participating in our homeowner insurance market, please come to the table. I'd like to welcome Joel Loucher, Chief Deputy Commissioner, California Department of Insurance. Rex Frazier, President, Personal Insurance Federation of California. Amy Bach, Executive Director, United Policyholders. Tom Welsh, General Counsel, California Earthquake Authority. And John Rollins, Actuary, Milliman, and former Chief Risk Officer of Citizens Property Insurance Corp. Yes, you provide our executive officer, thank you. And I believe everyone's been asked to take about 5 minutes. Is that accurate, Evan? Take about 5 minutes to. Yes. Everyone will take approximately 5 minutes, with Mr. Loucher taking a bit longer as he sets the stage on the residential insurance market. And the commissioners, if you have any clarifying questions, that's fine. But my recommendation would be that we wait until everyone does their 5 minutes and then we begin to ask questions of the panel. Thank you. Mr. Loucher, are you ready?
Yes. Picking up the PowerPoint. Okay, I have a PowerPoint for the audience, so thank you for having me back. I appreciate it, and for you taking in this information. I'm going to try to go through this PowerPoint very quickly because I know we're trying to get as much information out there as we can. I just want to reiterate that the way insurance works, homeowners insurance in particular, it looks at the very recent past to predict the very near future, right? So it is very reactionary to very current events in how rates are set and how underwriting works. And the very recent past that we are looking at in California is fraught with wildfires. So here you have a slide that shows the 20 largest or most destructive wildfires, in California history. You would see 10 of them happened in 2015 or later. And so this is the world that insurers are looking at. And these are the losses, insured losses that arose from those fires, over 12 billion in 2017, over 13 billion in 2018. Which means for insurance companies in 2017, a 201% loss ratio. That means for every dollar of premium, they paid out $2 in losses. 2018, not nearly as bad, but this would be the second worst year probably in California history for insurers. So, and in 2018, coverage for fire, that covers a lot of dwellings and commercial buildings, not on a homeowner's policy or a business owner's policy, but coverage for fire also spiked up above 100%. You see 170% there. And that includes the FAIR Plan, which writes risks that can't find coverage anywhere else. FAIR Plan had a 257% loss ratio for 2018. It's blank.
Oh, blank. Okay. All right. So then we start to see, well, what are
what is the insurance industry's reaction to all those losses? And we start to see them in different ways. One way here is we look at a comparison of complaints that the department receives. One set of those complaints, we're putting the overall from statewide. The other set of complaints, we've broken this down as for the counties designated by CAL FIRE as having the highest fire risk. You can see that for example, the top row there of renewal issues, consumer complaints we are receiving has gone up by over 500% for those designated counties, while it's going up 73% overall statewide. So by far that growth about in terms of having complaints about availability of renewal coverage and getting non-renewed is coming from homes in those high wildfire areas. The same with premium increases. Department's getting massive numbers of complaints about, or massive increase in complaints about cost increases for their insurance coverage. Now the numbers there are still rather small overall, compared to the California insurance market. And as I had pointed out last time, we are also seeing significant growth in our FAIR Plan writings for those high wildfire areas. You can see by this number that they've climbed over the last 5 years from 22,000 to 33,000 in wildfire areas. But again, pretty small numbers compared to the overall California marketplace of over 8 million homes. So that's one way. We're hearing non-renewals, we're hearing rate increases, and just a little further information on that rate increase piece. The department currently has 30 pending homeowners rate increases. This is probably, I would say, a record amount pending at any one time. We had about 50 filings for rate increases in 2017 and 60 in 2018 just for the homeowners line. And that means that insurers are filing back-to-back rate increase requests for approval. Now, one thing, just as an example that I want to point out, this is for a rate increase proposals not yet approved, but it's for an insurer that segments their rates along a fire line risk model grid. And if this is a little bit hard to read because it's got a lot of detail, but if you could look closely, you can see for a fire line score of 0, meaning a person that doesn't have a wildfire risk, a home probably embedded in an urban area, the increase on that factor is none. It's a factor of 1 and will stay a 1 under this proposal. If you go all the way to the bottom of the chart, you'll see a score of 30. So a fire line score of 30, the most likely, most at risk for a wildfire. The company is proposing to move from a factor of 2 to a factor of 3. So it's already at a double what another home would be, and this would move it to triple what that would be. But one thing you might also notice about this chart, because it shows earned exposures, those are the numbers of homes written by that insurer at that score level. You can see that by far the biggest mass of homes is down there at that 0 score. And then for the score of 30, there is only 1 home. In fact, there are very few homes written by this particular insurer above 15, really. Very scattered numbers. And so when you see, companies come in for something like a 7% rate increase, but that rate increase is falling very heavily on people in those higher scores. You see in this example, the people at the lower score aren't seeing a rate increase at all. So the point there about insurance is that insurance reacts to risk. As its costs go up, it turns those costs right back into costs for insurance. As its losses go up, it reevaluates where it wants to write business. So it's quite reactionary kind of business. Now, the department has looked at the issues that have arisen. We did an availability and affordability report into 2017, and we came up with some recommendations. Two of those that I just like to highlight there in the blueprint are really about recognizing mitigation in risk, trying to either mandate possibly that coverage be provided to homes that meet certain rigid mitigation guidelines, or at least build mitigation credits into an insurer's rating plans as a requirement. Neither of those have been acted on. The only one that has been acted on is the last one, which is trying to stabilize rates and the marketplace a bit for insurance consumers. SB 824 by then Senator Lara did have a bill that came into law that gives people in wildfire areas who don't suffer a total loss some protection on renewals. But it also mandates a collection of catastrophe loss data that all insurers can then use and have provide more credibility to their rates, which is very important when you see how few structures are up at those high risk levels. You can see that insurers essentially are just trying to apply logic in their rate approach there. They're not really having credible experience at this point for any one insurer. So there are other improvements that insurance could, that insurance would be better placed with. So for example, and we are dealing with this from 2015 wildfires, 17, 18, underinsurance problems still exist. And here we are in an era of big data when you can model losses, you can figure out, things that project into the future. And here we're talking about basic construction costs, things that already exist. The prices are there in the store, they're available online, and we're still getting this issue wrong for consumers. We have other issues there. You find a lot of people right now getting non-renewed who are in the fire areas. They didn't suffer a loss, but because there's only a 45-day non-renewal protection in California, it doesn't matter if you've been with that same insurer for 20 years, never had a loss, never made a claim, never been late with your premium, mitigated your own risk, you can be non-renewed on that very short notice. And perhaps people in those scenarios deserve some longer notice. There are also no clear standards that have been created for a fire-resistive structure. So there's no target for consumers to aim at, well, what is it that is the official recommended level of protection that I can do? So, that hasn't been established. And right now we're running into insufficient coverage limits in both the guarantee fund and in the FAIR plan. FAIR plan has $1.5 million limit. And as you can imagine, in California today, the reconstruction costs of many homes exceeds $1.5 million considerably. So another thing that has happened is that, the world has flipped on a lot of people who bought inexpensive homes in outlying areas, and insurance was never an issue. And all of a sudden, it's become difficult to find and very expensive. So, there are people on fixed incomes who there's no way for them to adjust to that reality, right? They're just in an absolute bind. And so maybe there should be something to consider those particular insureds on fixed incomes. But that does send the message to everyone. We keep talking about availability and affordability. there isn't a guarantee of insurance affordability. The way California homeowners business is rated today, or how premiums are calculated, is based on a number of individual factors, including the age of the home, how long you've lived there, the type of roof, the zip code, the protection class, the wildfire score. Nothing is taking into consideration your income, and people need to know that. And if there are going to be solutions perhaps to help people as in the predicaments they're in today, maybe that should be taken into account for something outside of the insurance kind of solutions. But insurance is simply a reaction to the amount of loss, and we'll charge whatever the predicted loss is for the upcoming period. And an important point to note, while we focus a lot on insurance, pouring more money into insurance solutions does not solve the bigger problem. Insurance is a product for the aftermath, right? It is an expensive salve to heal the wounds that come from a fire, but it does nothing to reduce risk. It is a response to risk. So if we're really hoping to make insurance more available and affordable, we have to address risk. And there are a lot of ways to do that. We've talked about them before, but they are really about state and community efforts to reduce the amount of risk, either through the dwelling structures and building structures themselves, or the environment, right? Reducing brush and creating infrastructure that makes risk go down for the homeowners that live in that area. And I want to mention here as an example, we see in the Netherlands where they put a massive investment into risk mitigation efforts. It's kind of been a European thing, it seems like, to focus more on pre-loss efforts rather than post-loss. And I'm hopeful that one of the things that will really come about here in California is that we put much more effort ourselves into reducing the loss so that we don't have the loss of lives and the personal turmoil and displacement that our citizens are experiencing today. These are efforts that would bring down the cost of insurance and make it more available. And I hope we're headed towards some of these solutions on a bigger scale.
Thank you, Mr. Loucher. And everyone, all the slides are available online for your reading now or at a later time. Mr. Frazier, welcome.
Thank you. Commissioners, my name is Rex Frazier. I'm president of the Personal Insurance Federation of California, and we represent admitted insurers on residential property insurance issues, including the National Association of Mutual Insurance Companies. Thank you for the opportunity today to testify about current trends in the homeowners insurance markets, as well as potential future challenges. In the big picture, every Californian continues to have access to insurance that protects against fire risk, and the claims from the 2017 and 18 fires are being paid. The admitted market continues to serve the vast majority, over 97% of the insured structures in California. The private backstop for high-risk policies or properties, known as the FAIR Plan, has grown on a percentage basis, but still serves a small proportion of insured structures. The non-admitted market has also grown in the last several years, but still represents a small amount of the market as well. Each of these market segments serves Californians without concern about solvency or the need for state help. Despite the catastrophic losses from the last two fire seasons, only one licensed insurer has failed. While it was small, Merced Property and Casualty was a venerable company operating since 1906. And even with an A- rating from AM Best, Merced was nonetheless taken down by a single event, the Camp Fire in Paradise. Fortunately for Merced's policyholders, all other admitted insurers immediately stepped forward through the California Insurance Guarantee Association to pay claims for Merced and only later will they seek reimbursement from Merced's estate. The insurance industry in California is resilient, but there are issues worthy of your consideration. The insurance industry's ability to serve high-risk properties is directly related to its relationship with the California Department of Insurance, which has a dual role. On the one hand, the department is empowered to prevent excessive rates and can even order insurers to reduce previously approved rates that it believes have become excessive over time. On the other hand, the department must monitor solvency to ensure that insurers can pay claims. In this balancing act, if the department restrains an insurer's rates too aggressively, it places financial pressure on that insurer, which will then react by reducing exposure to higher risk areas. As this commission considers the ability of the insurance industry to serve homes in wildland-urban interface areas, it is important to examine California insurance regulation. According to the National Association of Insurance Commissioners, as of 2016, California had the 32nd highest average homeowners insurance premium in the country. And when adjusted for average household income, this dropped to 43rd lowest in the country. This lower premium level was a stark level from several years before, when in 2009, California had the 14th highest average premium. 14th. During that period, the average homeowner's premium in the nation increased by 45%, while in California, that average increased by 8.1%. Hurricane-exposed states such as Florida and Louisiana have average premiums almost double that in California. With restrained rates, there is always a market response. Even before the 2017 fire season, the homeowners insurance market was already reacting. According to the state's fourth climate change assessment, while the statewide number of surplus line and fair plan policies had not increased for the previous 15 years, total policy count in high-risk areas had already started to increase by 2014, well before the 2017 fire season, and this development was predictable. As the admitted market reacted to concerns about price adequacy, local government officials in WUI areas became more vocal about the availability and affordability of homeowners insurance. And this is a disconnect of high importance. While the Gulf states have already had a climate-driven increase in insurance rates, California has not. California law continues to prohibit insurers from using climate change modeling in pricing, instead requiring insurers to predict future losses based on the average of the last 20 years. California's recognition of a new normal does not yet extend to insurance rates. This climate change restriction is on top of California's continued prohibition on allowing insurers to include their actual cost of reinsurance in their insurance rates. As the world reinsurance market recognizes California's climate risk and seeks higher prices from California insurers, California law continues the legal fiction that insurers do not buy reinsurance. While we're not here to criticize these California policy choices, as long as policymakers accept the predictable consequences. But policymakers periodically condemn insurers for being more selective about which homes and communities they will insure. There are even policy proposals to restrict the abilities of insurers to reduce their risk to match their approved rates. But such proposals would only trigger the very market crisis that they purportedly address. While there is not presently a market crisis for homeowners insurance in California, it is certainly within the government's power to create one. During last year's hectic debate about utility-caused wildfires, few had time to understand the difficulties already present in the insurance industry. So we're grateful that the Commission is willing to explore the complicated and competing interests in the residential property insurance market in California. I appreciate your allowing me to testify, and I'll submit a much more detailed set of comments following the hearing. Thank you.
Thank you, Mr. Frazier. Ms. Bob, welcome.
Thank you and good morning. I too appreciate the opportunity to be here and be of service to the commission. And this is obviously very timely, factual undertaking. And I really want to highlight a couple things that Joel mentioned before I just review my brief points. And one is obviously.
For that audience, who you represent?
Oh, sure. Yes. I represent United Policyholders. We are a 501c3 nonprofit organization. We were founded right around the Oakland Berkeley fire. And so we've been responding as a charity to wildfires for the last 27 years. So that's my background. The remarks that I distributed to the commission members earlier has one of our 3 logos, the Roadmap to Preparedness program. We also have a Roadmap to Recovery program, which has given us a lot of exposure on the ground after disasters to how well insurance safety nets are performing for the property owners that have invested in purchasing those safety nets. And we conduct periodic surveys, and I've had the privilege of engaging with the legislature many, many times over these years. So as far as Joel's excellent presentation, I just want to echo that I think we all understand that this is a nuanced problem that's going to require nuanced solutions, and the private insurance system is incredibly important, but is only part of, as Joel mentioned, the whole picture of what needs to be done by responsible policymakers that are looking ahead to what is coming down the line. And I wholly agree with Rex Frazier as well that we're not in a crisis situation in terms of, we're not like Florida was, where all the private companies in Florida, after a spate of bad hurricanes, pulled out and everyone ended up in their equivalent of the FAIR plan. And then the state basically had to offer sort of cash incentives to get insurers back in. And I think those of us, such as myself, I participate at a national level. Those of us who have seen what has happened in the Gulf Coast states are very much hoping to avoid anything like that here. And that includes your member, former Commissioner Dave Jones, who also has been privy to working with the Florida, Mississippi, and Alabama regulators. And a lot of what you're already hearing about this morning are issues that those states have already dealt with, which is the effect of big data, of modeling on rates and what that does to the cost of insurance, as well as this scenario that Joel outlined of the person who bought a home in a rural area or even in a coastal area is not a wealthy person, but they happen to live there and work there. And suddenly the cost of their insurance has become a huge problem for them, and they're trapped because they can't sell because of the insurance price tag, and they're captive because if they have a mortgage, they are legally required to keep homeowners insurance in place. So starting from that vantage point, I want to just do a quick recap of history here in California and say that it is definitely not our rate regulation structure that needs to be reformed, in my opinion. I think we have a very respectable, professional system. When an insurance company wants to raise their rates, there's a fair, balanced system for them to go in and do that. So I don't know that we need regulatory reform here. I think we also have to recognize that, yes, Joel gave some very scary stats on loss ratios, but let's all remember, insurers are not just living in the 1 year, right? They obviously have a history of, say, 20 years on a property with no claims. So I think that loss ratio is probably the only thing I would take issue with Joel on, is it makes it look like, oh, why would they stay in this business when it's so unprofitable? The reality is the California insurance market for home insurance remains very profitable for insurers generally, despite these cats, because it's still a fraction of the number of policies they have outstanding in the state. And still, nationwide, only something like 6% of all homeowners file claims under their policies. So again, just keep the big picture in mind. So the brief historical trip I want to take you on, I wrote it out here so you can have it, we can go quickly. It is after the Oakland Berkeley fire, 1991, recovery challenges included underinsurance, improper and inconsistent claim handling, confusion over the different forms of policies in terms of did they provide replacement coverage or did they provide guaranteed or extended or actual cash value. Construction cost demand surge pricing, the availability of temporary housing, exclusions for upgrades mandated by building codes that some people have, most people had in their policies, disputes over betterment in the rebuild process. Well, okay, I think those people in the audience that are here because of their personal experiences are saying, gosh, did we make any progress? Those are the exact same problems that we've been experiencing here and that people are experiencing in Butte. So we do have some systemic problems that could use attention in terms of improving the flow of insurance dollars after disasters. But that said, I think a lot of people in the face of these challenges have been relying on supplemental sources to fill their insurance gaps in order to rebuild that are sort of non-traditional, and that would be suing a utility, hiring a lawyer and suing the insurance company. Those are some of the strategies people have been forced to use when their insurance funds fall short. Whether that is the way we want to keep going or not is part of your charge, but that is the reality. So obviously, United Policyholders believes that the insurance system is a good one when it works, but we very much want to see consumers who put their money into the system be rewarded and have that safety net deliver for them. And we are very concerned about some trends. And one of the things that I attached for you to my remarks is an example of a new endorsement that one insurance company has rolled out, where they are actually looking to separate fire insurance from wildfire insurance. And that is a very dangerous trend that I hope is going to be nipped in the bud quickly. We do have in California, among the many smart things that the legislature has done, we have a floor of that below which no home insurance policy should fall, meaning Insurance Code Section 2071 says that if a policy is issued in this state that purports to protect a home, it cannot provide less than the minimum coverages set forth in that statute, and fire is one. In fact, it is called the standard for fire insurance policy. So please, if you do nothing else here, please let's nip this in the bud of trying to parse that there's a different recovery or coverage standard for wildfires. So we had the Oakland Berkeley firestorm. We talked about those problems. Residents in that area experienced problems with non-renewals. Our organization with the city of Oakland launched a pilot called Matchup, where we connected homeowners who'd been non-renewed with, generally speaking, an independent agent or broker that had access to a number of different carriers, so they could replace their coverage. The program served its purpose, it went away. The legislature at that time also enacted a disclosure form to try to combat this problem of underinsurance, where people said, well, I didn't know I didn't have full coverage. So the legislature took a stab at solving it with a disclosure form, which has subsequently been amended at least once, maybe twice. We also implemented these fair claim settlement practices that are now in the regs. Marketplace changes at that time included the disappearance of guaranteed replacement cost coverage, and basically now the norm is when you buy a homeowner's policy, if you have a good person advising you, you buy extended replacement in the biggest amount you can, and that kind of has become the norm. Our organization has been encouraging for decades that the exclusion for building code upgrade should not be part of the policy, because it just causes problems and confusion, and obviously we want people to be in compliance when they rebuild. The wildfires in '93 and then 2003, 7, and 9 in San Diego and Los Angeles, the competitive market handled it well. The FAIR plan did grow, but still we did not have anything that you'd call a crisis along the lines of what we saw in Florida and Mississippi and Alabama, and also Louisiana. So the FAIR plan product continues to have problems, as Joel mentioned. It doesn't have enough coverage, basically, and it is, of course, the market of last resort, but it is better than nothing. That's what we always tell people, and there have been sort of ongoing efforts to improve that program. And I think Commissioner Jones was very involved in as was Joel, in his tenure and trying to make the FAIR Plan healthier in terms of providing coverage that would actually get people back into a rebuilt home. So then the legislature, of course, has been very active in homeowners insurance legislation. The legislature mandated that in response to people coming up short on their temporary rent, for if they only had 12 months, the legislature mandated 24, and again, more recently 36. So the legislature has had these issues on their radar. But then in 2016, again, our organization was not getting the complaints that we were getting from Gulf Coast people that, you know, I'm priced out, I don't know what to do, I'm stuck, I'm losing my home. But we were starting to hear from people getting non-renewed. We got a call from then Assemblyman Obernalty's office saying rates were going up 600% in his area. His own home insurance was dropped. We stepped up our monitoring of the availability of home insurance. We engaged with the Department of Insurance. We urged a statewide data call. We launched our own survey. At this time, same time, the governor had created a tree mortality task force, and they created an insurance subgroup that was immediately looking into this issue that Assembly Member Obernalty raised and made other people were starting to raise of like, what's going on out there? How are rates doing? Are people getting priced out? Is there an availability problem? Is there a crisis? Let's work together to keep that from happening. But we really didn't, nothing really tangible came out of that other than my organization was encouraging insurers at that time to look towards mitigation, building our research, building the ways, the things that people can do to make it less likely their home is going to be destroyed in a wildfire. So technical support. We didn't get a lot of cooperation at that time from the insurers that were participating. I think they continue to sort of focus on, well, we want regulatory reform. I know. So at that time, we intervened in a rate proceeding because fire line scoring was causing problems. Then more recently, we partnered with a B Corp to create a new version of the matchup program. And to wrap up, obviously, we certainly understand how insurers are seeing the situation. I think we all have concerns, and no one, they're not for profits, they're for profits. So we understand that. But in the solutions that United Policyholders has been advocating, they're all measured, meaning, okay, we understand that the risk looks like it is greater, but let's not go overboard. So the legislative solutions we have advocated for, and Joel laid out 5, we support all of them, focusing on mitigation, but we have also advocated that the current non-renewal rules need to be amended. We gave a proposal to then Senator Lara, now Commissioner Lara, that was based on a Pennsylvania statute that has non-renewal rules being the same as cancellation rules. That triggered a sort of a nuclear reaction, no. So somewhere in there, we've got to find a better solution. 45 days in this market is not enough time for people to replace their coverage with quality. They can go to the surplus lines market, and they are, and we need to understand more how many people are going into the surplus lines market, because that has no underlayment of CEGA. There's nothing below those surplus lines companies if they go belly up. So thank you for your time, and good luck with your charge.
Thank you very much, especially for the context and the written materials. I'm actually going to ask Mr. Rollins to speak next, and then we'll wrap up for you.
Sure, thank you.
Thank you.
Thank you, Madam Commissioner, Madam Chairman. Can everybody hear me?
Yes.
Thank you for inviting us today, Madam Chairman and Commissioners and members of the Californian public that are here. My name is John Rollins, and I'm an actuary with Milliman. Milliman is a global firm of actuarial professionals. I represent the Property Casualty Tampa office, and we are very closely allied with the San Francisco office, who is working with the commission. And we were asked to testify actually on a very interesting question by your executive officer. And the question is, can California learn something from Florida's experience in stabilizing its residential insurance market? And I'll speak on that briefly. So over 25 years ago, in the wake of Hurricane Andrew, Florida faced an acute availability and affordability crisis in homeowners insurance. An abrupt rise in insurers' cost of capital after that unexpected and severe storm kind of broke the connection between the property hazard risk faced by consumers and the insurers and reinsurers who commit the capital to share that risk. Florida had an existing guarantee fund which dealt with the insolvencies, but responded to the state's future needs by chartering a trio of institutions. First, a state-backed scientific body to assess hazard risk. Second, a state-backed reinsurance company. And third, a state-backed direct insurance company. And each institution plays a unique role in market and stabilization of the market. First, recognizing that scientific catastrophe simulation models are essential in managing and measuring Florida hurricane risk, the Florida Hurricane Loss Projection Methodology Commission, sorry, that's a mouthful, we call it the Commission in Florida, affirms that the models underlying these insurance rates are accepted by experts as accurate and reliable. Second, recognizing that insurer solvency is dependent upon the prudent use of reinsurance, but that market forces could cause large swings in reinsurance costs. The Florida Hurricane Catastrophe Fund, or CAT Fund, helps ensure reinsurance availability and affordability. Finally, recognizing that the availability and affordability of insurance to the consumer is also dependent upon market forces, Florida created Citizens Property Insurance Corporation, or Citizens, to provide a market of last resort for Floridians, and it is the successor to a FAIR Plan and a wind pool in Florida. So since Andrew, the state has also encouraged fortification of both new and existing homes through a number of mechanisms, which have resulted in reduced losses in recent hurricanes and lower premiums to millions of Florida homeowners. So I'll discuss the salient features of these institutions and how they're connected briefly. Hurricanes are infrequent yet severe, similar to wildfires, and the losses they cause depend in part on building codes, home locations, mitigation features, and other things that change over time. Historical experience is by itself thus insufficient to set the rates. So instead, insurance companies use catastrophe models embedded with the latest science to reflect the range of potential storm outcomes under current conditions. However, insurers may only use catastrophe models accepted by the Commission in residential rate filings in Florida. The Commission itself is a body of about a dozen scientific experts funded by the state, most selected by our governor and chief financial officer. And it publicly reviews private and a publicly funded Florida hurricane model every other year. And these models must meet over 36 rigorous standards regarding meteorology, engineering, statistics, actuarial science, and computing. Interestingly, other states' regulators often refer to Florida's results. Insurance companies buy backup protection called reinsurance because catastrophic event losses could exceed their available capital and threaten the ability to keep their promises. Now, reinsurance costs are unregulated and vary with the risk of the insurer's book of business, but also with just the global supply and demand for capital. Florida law allows insurance companies to pass reinsurance costs to policyholders within insurance rates, subject to some limitations and a strict regulatory review. The CAT Fund offers a standard contract to reimburse insurers for hurricane losses only, excess of a retention up to a fixed annual aggregate amount, at rates that are calculated by its actuaries after those actuaries review the Commission-accepted models. The retention and payout are set by a formula in law, and then the contracted rates are approved by the state each year. The rates cover the CAT Fund's expected annual costs, plus a 25% loading to help it build up cash. CAT Fund participation is mandatory for both Citizens and the private insurance companies in the state. And the private insurers can select a co-payment level of 10%, 25%, or 55% to help share their risk. In the past few years, the CAT Fund has itself bought private reinsurance and then passed through the costs in its rates, and it can also borrow pre-event debt to ensure liquidity. The CAT Fund ensures reinsurance is available for part of the hurricane risk of insurers at a relatively stable cost, but its promised payout could exceed its own capital and reinsurance. And in this deficit case, it would borrow post-event and service that debt by levying emergency assessments on nearly all Florida insurance policies of up to 10% of annual premium for as long as it takes to retire the debt. Now, at times of accelerating claims costs or high reinsurance prices or underwriting restrictions, insurance for some types of properties, such as coastal homes or older homes, becomes insufficiently available or affordable or both around the state. Citizens was formed as a stable source of coverage, and it is governed by a board of 9 volunteers appointed by the governor, CFO, and legislature. It's regulated under the Florida Insurance Code, just like a private company, but also a law containing specific requirements for citizens. The keys to its role and ability to coexist without crowding out the private market can be summarized by an acronym that I think of as CARES: coverage, acceptance, rates, education, and solvency. First, citizens coverage has to be comparable to private insurers, but the board has some authority to adjust coverage if the regulators agree. Second, citizens offers policies direct to consumers, but it only accepts a new policyholder after agents apply using what we call a clearinghouse comparison shopping platform. It's only when no private insurer offers comparable coverage at an approved premium within 15% of citizens' rate is the policy accepted. And upon renewal, that goes down to zero. You cannot be kicked out of Citizens to get a higher rate in the private market. Third, Citizens rates are proposed by its board annually and publicly reviewed by the regulators under all rating laws and rules, plus a Citizen-specific law we love in Florida called the glide path, which limits rate increases for any single policyholder to 10% per year. Citizens, like private insurers, however, passes through the cost of the reinsurance it buys and its catastrophe bonds to the policyholders and its rates. Fourth, Citizens commits many resources to ensuring Floridians know when Citizens is an option, when coverage is provided, how to report claims, and importantly, that their policies may be assessed after a big storm. Finally, Citizens funds its obligations by building surplus during storm-free and favorable years, maintaining a robust reinsurance program that uses three sources of capital: its own surplus, the CAT fund, and reinsurance in the form of traditional contracts and catastrophe bonds. Like the CAT fund, if an annual deficit occurs due to storm losses exceeding cash and reinsurance, it can assess nearly all Florida insurance policyholders up to 10% annually, as long as it takes to cure it. Those Citizens policyholders pay a one-time surcharge before that assessment starts. Now, all these institutions have been influenced by a steady improvement in building codes and in investment and an emphasis on loss mitigation. Here's how. Since the seminal adoption of a South Florida building code in 1994, a statewide building code in 2002, a state-funded mitigation grant program in 2006, and then expanded insurance company discounts for loss mitigation starting in 2007, the models, hurricane models, catastrophe models that have been accepted by the commission, and therefore the rates charged by the CAT fund to Citizens, have increasingly differentiated well-built and protected homes from other homes. And by Florida law, private insurers must provide very significant mitigation discounts to those better protected homes. Consumers have responded to these risk signals, and recent hurricanes have shown the impact of this effort in reducing damage to those better protected homes. In summary, Florida faces the central challenges of balancing the respective needs of property owners, insurers, and taxpayers, using the latest science to measure risk while ensuring transparency, and ensuring that insurance rates reflect scientific cost estimates that also encourage mitigation, but properly signal risk to consumers while keeping the cost of living affordable. It seems like California faces most of these same challenges. The Commission, the CAT Fund, and Citizens are instruments that Florida has created to meet these challenges. Milliman has done a great deal of work in Florida, but also in California and other states, and we stand ready to help Californians understand our experiences if there's any way we can help. Thank you, Mr. Chairman.
Thank you very much. Mr. Welch, welcome.
Thank you, Madam Chairman. And thank you, commissioners, for giving me an opportunity to explain the background of the California Earthquake Authority. My name is Tom Welch. I'm the General Counsel of the Earthquake Authority. For those of you who aren't familiar with the Earthquake Authority, it is a nonprofit, publicly managed, but entirely privately funded insurance company that offers Californians access to residential earthquake insurance. What I'll do is go briefly through the history of the Earthquake Authority, how it was created, how it's evolved over time and improved its operations and long-term stability, and talk about its current focus on really maximizing its emphasis on one of its missions, which is mitigation. So first, to the history. The history really starts, the foundational part of the history is that damage from earthquake is excluded from traditional homeowners insurance policies. But back in 1984, the legislature passed a mandatory offer law that said that any admitted homeowners insurer here in California that wanted to continue selling homeowners insurance had a mandate to offer either a supplemental policy or a standalone earthquake insurance policy so that peril could be covered. At the time, the insurance industry, the science wasn't quite as good, and the insurance industry's focus on pricing for that product wasn't as strong and focused as it is today. Consequently, it was somewhat uneven in the marketplace in terms of how the product was priced. What you saw was a very significant take-up of that mandatory offer in Southern California and in San Francisco and the greater Bay Area. Basically, you can follow the seismic high-risk zones of the state and see where the take-up was. And it was uneven. We often talk about the California Earthquake Authority as having been born out of the aftermath of the Northridge earthquake down in Los Angeles, which was a 6.6 earthquake that happened in January of 1994. But really, to put it into context, what happened was you had a series of two very large earthquakes, Loma Prieta in 1989, which was even larger. It was 6.6, I'm sorry, no, it was 6.9. The Loma Prieta earthquake caused a tremendous amount of infrastructure damage in the Bay Area. And it was followed less than 5 years later by another similarly large and damaging earthquake. And it was at that point in time, especially focusing on Northridge, that we had effectively an insurance availability crisis that emerged. Northridge produced about $40 billion of property damage. Of that, about $20 billion was residential. And of that $20 billion in residential damage, $10 billion of that was insured. In the aftermath of that, you started to see the insurance industry really focus in on where they should be writing homeowners insurance, because they had to comply with the mandate to offer earthquake insurance. And in relatively short order, you saw a pullback from the marketplace that produced not just an insurance availability crisis, but as important, a real estate transactional crisis. You can't buy or sell a house if you're going to get a mortgage if you can't get homeowners insurance. So in 1995 and 96, the legislature took action and dealt with the availability and real estate crisis through a series of pieces of legislation that ultimately created the California Earthquake Authority. There were a couple of triggers in the law that had to be met before the CEA sprang into being and could start issuing policies of basic earthquake insurance. One was we had to have the IRS agree that the Earthquake Authority could accumulate premium dollars on a tax-exempt basis, because financially the only way this was going to work was if the premium income coming into the Earthquake Authority could be retained and preserved and grow over time without federal income tax consequences. The IRS participated or agreed and met that, and found that CEA was an integral part of the state, even though it was completely privately financed. It was performing certain important public functions across the state, including focus on its insurance or earthquake education and mitigation programs. The other trigger was that 75% of the homeowners insurers, or insurers representing at least 75% of the market share, had to agree to participate as insurers in the Earthquake Authority, and had to actually sign a financial commitment that they would pay their share of the initial capitalization into the Earthquake Authority. That was also achieved. And then finally, the Earthquake Authority, before it could start issuing policies, had to get firm commitments from reinsurers that they would provide coverage that was at least 200% above the paid-in initial capital that was provided by the participating insurers. And all of those triggers were met, and the CEA sprang into being. It now has 24 participating insurers that satisfy their mandatory offer obligation with respect to earthquake by offering a CEA policy. And they also have participated in capitalization, and they bear and continue to bear a significant amount of the financial risk. I mentioned it's publicly managed and privately financed. Our governing board consists of the governor, the insurance commissioner, and the state treasurer. We also have 2 non-voting board members, the assembly speaker and the chair of the Senate Rules Committee. We currently have in excess of 1 million policies in force in California. And I'll get to in a second what our claims paying capacity looks like, but it's financially very strong and is rated A- by AM Best, Fitch and Moody's. Over the last 20 years out in California, a lot of things have changed. That the cost of reconstructing homes, even absent a catastrophe, has increased by 170%. Meanwhile, CEA has, through management and intensive focus on enhancements to its policies, been able to bring down its average premium by 55%. Without the rate reductions that the CEA has been able to impose, CEA policyholders would be paying about twice as much today as they were when CEA was created 25 years ago. Originally, CEA was offering just what we refer to as the mini policy. The statute calls it a policy of basic earthquake insurance. It covered replacement costs, just $5,000 maximum in personal property loss. The deductible was a standard 15%. And the only loss of use or continuing living expense coverage was just $1,500. There was no discount offered on premiums based on mitigation. Today, with the help of the department and CEA management, the options are significantly more flexible and more valuable to consumers. We still cover replacement costs, but now you can buy up to $200,000 worth of personal property coverage. There are choices with respect to deductibles, 5, 10, 15, 20, or 25% deductibles at the election of the policyholder. Loss of use has gone up to $100,000 available to policyholders who want it. Importantly, mitigation discounts for those homeowners who focus in on the vulnerabilities of their home and do projects that can be verified as seismically strengthening their homes. They're entitled to up to a 25% discount on their premium. A lot of Californians have responded to those changes. Between 2006 and 2015, the average annual increase year on year in CEA's policyholder count was only about 6,700 policies per year. When we started to implement these broader policy choices for consumers, that jumped to, in 2016, 52,000 policies in 1 year. The next year, 2017, we brought on 90,000, and it started to come down a little bit, but in 18 we had nearly 30,000 new policies, and just in the first 2 months of this year, we've brought on another 4,000 policies. Now, what I think is particularly relevant to the commission is how CEA's claim paying capacity is structured. We refer to it euphemistically as either a tower or a layer cake. The layer cake is often depicted in colors that don't occur in nature, so aren't necessarily appetizing, but think of it as a stack, with each stack indicating a different source of capacity for paying claims after an earthquake. The first layer, the working layer, is the capital, the cash in the bank that CEA has accumulated over its 20 plus years of operation by issuing policies, and that amount is now just under $6 billion. On top of that, we go out to the reinsurance markets every year and spend in excess of $300 million on reinsurance. Above that, we've issued some bond debt, and above that, we have the ability, after an earthquake, to issue additional debt and repay that debt from surcharges that are imposed on our policyholders on a go-forward basis. And then the industry continues to be exposed and on the hook, the participating insurers, up to an additional $1.7 billion in the event we need resources to pay claims after a horrific, unprecedented kind of earthquake. Since CEA's inception, it's collected about $13 billion in policyholder premiums. It has paid about $5 billion in premiums to our reinsurance partners, the partners who stand by and are available to pay claims if and when that event happens. Over time, the history, and we will provide some graphics in our written submissions that explain this in more detail. Over time, that claim paying capacity tower has changed. In the first probably 10 years of the history, really the insurance industry principally was off on the first loss. They were the ones who put in the original capital that allowed us to start issuing policies. And they were an immediate response layer. It was called the first industry assessment layer. So if we had had, in relatively short order, an earthquake happening, the insurance industry would have responded to that damaging earthquake by paying in the industry assessment layer. That has changed over time. The legislature has imposed additional layers on the insurance industry over time. Those have burned off pursuant to statute. But now we're in this position where, fortunately, we've had a very long period of time without a large damaging earthquake. Everybody knock on wood. It is definitely coming, and we need to be prepared for it. But that's given CEA the ability to accumulate the strength to pay almost $18 billion worth of losses from earthquakes in a season. So it stands extremely strong. I want to focus last on the one element of the Earthquake Authority's mission. You've heard a theme throughout all of the speakers about the focus on mitigation and preparation. CEA educates, mitigates, and insures. Those are the three pillars of CEA's mission. And right now we're really focusing in on enhancing our contribution to California's preparation for the next big earthquake, because the best thing any homeowner can do is strengthen their home and mitigate it against potential damage. The South Napa earthquake produced a pretty amazing and striking photograph of two very similarly constructed, beautiful historic homes. One of them had been remodeled at some point, and the homeowner had decided to attach the home to the foundation. It was one of those classic pillar and pier, cripple wall homes where, built pre-1940s when concrete was actually quite expensive. So the standard was to create a concrete perimeter and then build a foundation on which you would build the home. They're very vulnerable in an earthquake. One home in the South Napa earthquake right next to another had been mitigated. It remained habitable after the earthquake. The house next door, owned by a woman who had owned the home for decades, had not been mitigated, and it fell off its foundation and cost her hundreds of thousands of dollars in several years to replace or to lift back up and put it back onto its foundation. CEA is really focused in like a laser on helping people get that kind of work done. We've stood up a program we call the Earthquake Brace and Bolts program that looks at, it has developed a standard building set and design for retrofitting those types of pre-1940s home, of which there's an inventory of at least 1 million homes in high seismic zones that have that kind of vulnerability. And we provide subsidies for that. We provide a $3,000 subsidy. The total project costs in Southern California are between $3,000 and $4,000. Up in Northern California, because of labor costs, a little more expensive. It's probably in the average of $5,000 to $6,000. And those are the kinds of efforts that, as the commission looks at CEA is instructive as an important public entity that was able to help address an availability crisis. We recommend that you really maintain that sharp focus on mitigation and preparation. Thank you.
Thank you all. Tremendous amount of important content that unfortunately, I wish we had more time to hear, but we look forward to having some follow-up conversations with you. Commissioners, we can take about 15 minutes at this point for discussion and questions. I know we all have several, so I'm going to recommend that we each start with 2 to 3 questions, and then if there's time left over, we can do another round. Commissioner Jones, would you like to tee us off?
Sure. I have a request of the Department of Insurance. Our enabling statute requires that we consult with the Commissioner of Insurance as well as the department. And you guys have been fantastic, Joel, in providing us with information. I would like to get some specific policy recommendations from you that are consistent with the bullet points on your slide where you showed some additional recommendations. I guess insurance consumers should be able to rely on their coverage. If you could give us some extra specific recommendations on that. And then any updates to the recommendations that were contained in the department's January 2018 report, Availability and Affordability. I think that'd be helpful and also consistent with the statutory direction that we have. Question for Mr. Rollins. It's great to see you again. Excellent presentation. I just want to make sure I have the context right, though. Hurricane Andrew, basically a total seizing up of the homeowners market in Florida, correct?
Yes, Commissioner.
Okay. California, 2018, crisis in Santa Rosa, Santa Noma, and other places, no question. But there are only 33,000 fair plan policies written in the state versus about 11 million homes. So would you characterize the condition that our market is in currently as being similar to the Florida market at the time that Citizens and all the apparatus was stood up that you just described?
I would not characterize the condition of your market as nearly as severe as the crisis that faced Florida in 1993. In 93, I was buying my first home as a young actuary, so I remember it personally and professionally. Milliman has provided your executive officer with some statistics in terms of our view of the market composition and market health of California. So I would say briefly that no, I don't think you're there yet. I do think some of the themes regarding the institutions and mechanisms that Florida chose to implement might be things that California finds instructive as you face the smaller level of warning signals that you're facing in your market.
Absolutely. Particularly, I'm keenly interested in, a number of you have spoken to this, maybe all of you, of the linkage between, an explicit linkage between mitigation efforts and availability and pricing of insurance. And I think that's certainly something that Mr. Lauscher talked about, Mr. Frazier, Mr. Welsh, Mr. Bach, Mr. Rollins, and I think it's something that we can learn from Florida with regard to that explicit linkage. Mr. Welsh, with regard to the inception of the Earthquake Authority in the wake of Northridge and before that, Loma Prieta, would you characterize our fire insurance, homeowners insurance market availability similar to the conditions that led the legislature to create the Earthquake Authority in 1994?
If I were to have to compare them, I would say that the environment, the availability environment in 1994 was significantly worse, but I will need to stay in my earthquake lane.
Sure.
Because I'm not as conversant on really what the environment and availability environment looks like now and how it may evolve. But certainly, if you were to compare apples to apples, there was a very serious availability crisis in 95, 96 after those earthquakes that precipitated the compromises that became the CEA.
Great. Mr. Frazier, appreciate your testimony, very thorough and comprehensive. If the Department of Insurance were to modify its regulations to allow homeowners insurers to include the cost of reinsurance in their rates, would your members make a legally binding commitment to insure the homes that they're currently declining to renew or insure in the wildland urban interface area?
Boy, that's tough for me to say that on the spur of the moment, what they would do. I'm certainly happy to have that discussion with them, but there seems to be little doubt that as as pricing flexibility would be reintroduced, one would have to think that the market would respond, certainly.
So I did ask them that question when I was the insurance commissioner and offered to change those regulations if I could get a legally binding commitment from the homeowners writers to insure the homes that they were declining to write renew, and they declined to make that commitment. So I appreciate the suggestion. I want to give time to my colleagues. I would like to give Mr. Lauscher a chance to respond specifically to why the Department of Insurance disagrees currently with the notion of allowing reinsurance pricing to be included in rates. Do you want to do that now, Joel? And then I'm done.
Yeah, certainly. Of course, reinsurance market goes, as Mr. Frazier mentioned, at a market rate, irrespective of risk or anything else. It's what the market will bear. We have a prior approval rate system in California to allow a non-regulated component potentially dominate that rate regulation system would undermine the system itself by creating prices that beyond the state's control. And I would also mention that, like when I showed the slide, 200% loss ratio, all of those losses are considered in the insurer's rates, even though we know a huge portion of those losses are being paid by reinsurers. So we calculate rates on a direct basis, even though the insurer may be getting reimbursement from its reinsurers for many of those losses. We don't take that, that isn't part of our system. We do it directly.
So you don't incorporate the cost of reinsurance, but you also don't back out the billions of dollars in payments the insurers get from reinsurance when you calculate their losses for purposes of setting their rates going forward.
That's exactly right.
Okay.
May I add one piece of information?
Use the microphone.
Thank you. What Joel indicated, there are two classes of business that presently are permitted to include a percentage of their cost of reinsurance in their pricing. Is that correct?
There are two that allow modeling of risk, I think is what you're referring to, earthquake, for example.
Yes.
Okay, I don't know that there's the cost of reinsurance for those, but.
I thought for a mid-mal and earthquake, you actually can include up to 30%. I thought was the reg.
That is right.
That is right.
Okay.
So it's not as if that what we're proposing is unprecedented because it's already permitted for two classes of catastrophic business already. It's not 100% pass through. It is a percentage basis, and certainly in my written comments, I'll cite you the regulations so you can understand what we're suggesting.
Thank you. Mr. Warren, would you like to go ahead?
Sure. The first question, my questions are really going to concern how well we understand this risk, because I think that's critical to our thinking, not just in the homeowners market, but also in terms of characterizing the risks faced by the utilities. I heard some discussion from you, Mr. Rollins, about the importance that the state of Florida placed on developing a really scientific and publicly vetted basis for characterizing the risk. It's my understanding that since Hurricane Andrew, there's been enormous investments in general in the CAT models that are designed to simulate hurricane risk and risk to individual structures from landfalling hurricanes in the United States. I would be interested to hear from the panel kind of how well they would characterize the state of wildfire modeling and risk-based wildfire price setting today. Do we believe the models? Do we have concerns about the models and a bias in the models? Where are the places where we need to be thinking about investing and understanding our risks in California?
I'll give a brief comment that might be helpful. I think we would say as actuaries that we are the downstream users of catastrophe modelers. So what the models put out, we then take up and decide how to fairly and in a non-unfairly discriminatory manner put into insurance rates. I think it's fair to say that Wildfire modeling is not as mature scientifically or in terms of computing or anything else as, say, hurricane modeling or earthquake modeling is. But then I would rewind to the Florida experience in 1993 and after Hurricane Andrew, hurricane modeling was not as mature as it is now. And so I would characterize what Florida did as perhaps taking a little bit of a leap of faith in terms of setting up a commission to vet these models and setting up a catastrophe fund and then ultimately a citizens property insurance to use these models and allocate and pass through the costs in a local way so that, say, Orlando residents don't pay as much as Miami residents do for the threat of hurricanes in their insurance premiums. But we did that when we knew models were less mature than they are now. What has changed, I think, is the pace of change in technology. It's just a truism that it's accelerated, and the use of big data and the ability to model at a highly granular level now is just unbelievably far advanced to where it was in the 90s. We still, at this point, vet hurricane models sometimes on a zip code basis. That's just not acceptable in the wildfire peril. It will never be acceptable. Fortunately, the tech and the data has improved significantly. So as actuaries, we like the trajectory of where wildfire modeling is going. We express no particular opinion on the policy of regulating wildfire models, but again, you could turn to Florida and say that state chose to hitch its wagon to modeling because it didn't want the extreme rate increases right after Hurricane Andrew that would have been caused by using only the recent history. But it also put a bunch of guardrails in place, and it's overseen by these various bodies, and then there's a lot of statutory and regulatory citations I won't bore you with, but I have bored your executive officer with those citations. So thank you.
So if I can share what I have gleaned from participating at the National Association of Insurance Commissioners over the time that we saw the development of computer modeling as the new way, sort of replacing traditional underwriting, that it is developing a public model, I think, is very valuable, because the privately developed models that are being sold to insurance companies are vulnerable to having the dials, shift to desired outcomes. And I think so that the public model in Florida, I think, has been a huge help. And so I would say that. And I would also say that I think regulators generally are struggling to keep up with the technological advances. And in general, I think our department as well is just right there with them, that things have happened so fast with the Fireline score modeling becoming such a big deal and having such an influence. And the last thing I want to say is that I was with an engineer yesterday. We're discussing how changes in a privately derived model can affect the market, and it can be extreme. So when RMS, which is a modeling company, came out, changed their model to RMS 11, and I don't remember what year, I'm sure you probably remember.
2011.
A lot of people pinpointed that as triggering a crisis in availability and affordability. So that is a definite fact that I wanted to share with you.
If I may offer one further observation, certainly the use of these vendor tools that the insurance companies have had access to, they report. The good thing about them is they allow the analysis to be a lot more granular for which communities, they can stay in all communities and try to be more discerning about what parts of each community they can remain in, whereas in the past, you might get a more crude decision of, well, we can't write above X number of feet in the mountains or under these conditions, and it was just a more primitive approach. And at least with the modeling, I think they feel as if they can be a lot more granular in their decision making and stay in a lot more places. Of course, whether they're explicitly by statute regulated or not, the Department of Insurance is going to not allow a use that it is uncomfortable with. And there's certainly a push and pull in that environment, because as the department's trying to figure out the robustness of the model, they're also considering public policy issues such as, well, should we allow the highest risk numbers to continue to sort of increase linearly in price versus sort of starting to push it on a curve so it flattens off at the higher level. So So the department is trying to figure out, A, are these good models, and B, do we start to sort of change the models in a way that can impose subsidies on, say, lesser risk properties in order to shield people from the highest impacts?
Yes, Commissioner Owens? Thank you. Commissioner Thomas?
First of all, I'd like to thank you for a wonderful panel. It was really, really informative. I want to focus my questions on the effect of law changes. And I'd like to also focus my question on this notion that there's a crisis. So, Mr. Lauscher, I'd like you to take a look at your slide number 9. And if you take a look at, this is the fire line wildlife rate factors slide. And do you have that?
I don't know if I'll bring it up, but I have it. I know the slide.
Okay, well, first of all, I would like to see data that's for as many carriers as you can provide for this, so that we can provide an accurate reflection to the legislature about what this concludes. You've given us one example. Is there more data for us?
Let me say this. This is simply a proposal by one insurer, and it is, their projection. Again, I don't know that we will ultimately approve this because it is a significant increase all along that ladder that you see. It's just, this is meant to show the insurer's reaction. We probably do have a pretty steep ladder that is approved for some other insurers at this point. The current fire line score factors are probably the more meaningful ones from this particular chart, just to show the differentials today. And the issue that we face with these models as regulators, while they have some what appear to be logical conclusions based on, in this case, fire science, they're not credible in terms of the data applied. We don't have, 50,000 losses for a risk score 30 in the last 5 years to validate these data points.
I understand that. I understand that. For me, the value of this is that it's a proposal, and I'm going to predict you're not likely to give these people greater increases than they've asked for. So
that's correct.
Okay, so this gives me an outside parameter of what the reaction to the fires is, and therefore I'd like accumulated data for as many of the carriers as I can get, so I can understand what the worst case is. So can you do that for us, please?
Yeah, although, and
Mr. Lauscher,
I'm glad to do
work with
that.
you to refine the request afterwards.
Yeah, I appreciate that. I will say Fireline is used by a small number of insurers. Some number use CoreLogic, several use their proprietary models. So the scoring, there isn't a standard scale, but I will get you what we have.
Okay, so if you take a look at this slide, your fire line score, that's what Commissioner Warren was talking about. That's the modeling internally of the insurance carriers, their prediction of what fire risk, isn't that right?
Yeah, this is the prediction of the rate differential that should apply. It's not a prediction of loss itself, but of fire risk differential.
Okay, so if we take a look at this, your 0 to 9,
yes,
that's well over 90% of the policies, and the first score is huge. 0 is the overwhelming number, right?
Yes.
So what I'm trying to understand is the effect of law change on rates and whether it will initiate a crisis. It seems to me that if the inverse condemnation law were changed one way or the other, in any way the legislature decided to change it, 0 fire score would not change in terms of the rates.
Rates actually are not set based on anything to do with that condemnation or reimbursement by the utility. They're based on a projection of loss for the coming year. So, the insurers don't count on whatever recovery they may or may not get from a utility when setting those rates or projecting those rates.
Are you saying that changes in inverse condemnation law will have no effect on rates?
They would have an effect that happens a few years down the road in terms of reducing the catastrophe loadings that went into the rates. In these most recent fires, because we've had multiple years with massive losses, 2015, 17, and 18, this 20-year cat load that we've talked about a little bit, as insurers in California may not like that all the time, but that cat load is a way to measure the impact that will apply to rates. But when you have significant 3 major years of catastrophes in these last 5 years, plus other events in that 20-year continuum, that cat load starts to be a pretty significant amount of the rate already.
I understand.
And so it would be reduced somewhat by a recovery from a utility. But we already had a couple of those major fires that weren't utilities, right? They were determined to not be from a utility. So insurers don't predict future rates based on a recovery from utilities.
So just want to make it clear.
Yes.
What you're telling us is that there's no reason to predict a change in the inverse condemnation law will result in a crisis in the availability of insurance. Is that right?
I would say insurers have gotten big recoveries. I can't predict what they do. They have gotten big recoveries. I'm sure they'd hate to lose the opportunity of having someone to go after if that party is responsible for the loss. So it can have an impact. It does have an impact on the catastrophe load. So I can't say what insurers would or wouldn't do, but that catastrophe load and that impact is probably more important about whether they might write in certain areas than certainly in that 0 area where they, there's no likelihood of loss in those areas.
I'll ask one more question and ask you the same question. We were supposed to recommend changes in the law or not, and I'm trying to understand if there's a consequence here.
There is a consequence. There certainly is. There's a consequence to the catastrophe load and maybe an insurer's willingness to write, because they may take into account the possibility of a recovery. But I would say as generally rates are set, they don't necessarily, when they put together the rates for next year, take into account what recovery a insurer may or may not get from a utility. It doesn't play an immediate role in insurance rates that are, like I mentioned, are very reactive to the most recent and for the very near future.
I think, obviously, as I said, people have been relying on where a wildfire destroyed their home, and they found themselves underinsured, which 2/3 of the people do. The ability to collect from an insurer, from a utility, has been extremely valuable and helpful. As far as, and the insurers, as Joel said, have definitely been working, using their subrogation rights to recoup a lot of what they've been paying out. If they have less funds available, I would assume that it's going to aggravate the affordability and availability problem if there's a reduction in the utilities liability.
Thank you, Commissioner Khan. And I'll just wrap up with one somewhat vague request and the second question. And the first one gets to the line of question from Commissioner Khan, which ultimately, in order to think about how to equitably allocate costs, we have to know who's actually paying the costs now. And so I'd like to get a better understanding of how much of the insurance loss currently is requested to be recovered from third parties, whether that be utilities or others. And I don't need an answer to that now, but helping us again to put those loss numbers in context. And then my second question gets at one of the leading ideas out there now to help deal with costs of some type of fund, some type of state-supported fund where we're pooling investments from different stakeholders. Does anyone have any thoughts about how the insurance companies themselves will participate in such a fund? And I mean specifically the companies and not just the policyholders.
No,
In terms of helping to capitalize an initial fund, there's been discussion about utility shareholders and ratepayers, other taxpayers. What role can you see for the insurance company?
You're asking if the insurance companies in particular, without talking about anyone else, whether it's local governments or anyone else that presently is involved in litigation with the utilities. Is your question, would insurance companies pay money to fund a fund that they would then make claim from?
Somewhat, yes. There's a lot of nuance there, what you just said, but
Well,
ultimately thinking about.
Ultimately, the insurance companies or the wildfire victims or local governments that suffer from utilities that would burn down a community, they didn't cause that fire. So the notion that people who incurred financial harm would be the ones that then are asked, well, put money in. What is an insurance company supposed to tell its urban Los Angeles customers, hey, we're going to take some money and we're going to go ahead and fund wildfire fund that other people are going to make claim to?
I'm thinking about it more from the perspective of these are companies that are in business managing risk, as was noted, they can make profit from managing that risk. And so I'm thinking more from the companies themselves in terms of helping to support a mechanism that provides greater assurances to all customers in the state.
To all of whose customers?
I'll be more direct.
Yeah.
More specifically, or maybe others can speak about this with some other funds. Are there opportunities for the insurance companies to contribute from their bottom line to help capitalize some initial funds?
For utility liabilities?
For fires caused by utility infrastructure or other causes?
Well, certainly when the insurance industry had its own market failure, and I was at the Department of Insurance in 1995 and 96 and was part of the team to negotiate the creation of the California Earthquake Authority. And in that circumstance, the insurance industry was really unable to serve its customers in the homeowners insurance market. And ultimately, the resolution that was the difficult negotiation leading to the creation of the CEA, the insurance companies, because they were asking for help, they put in, I forget the number, $740 million of initial capitalization, and they maintained a $4 billion contingent liability with the CEA for years, and now that number over time is down to, I think, around $1.7 billion, and the participating insurers, they retain that liability year in and year out. And so at least they understood in that circumstance, they were asking for help, and they were part of that solution. We're not asking for help here. So I'm just having a hard time understanding when utilities are saying they want state help, why would the response be to find someone else's pocket and say, hey, can you help too? When insurance companies are doing nothing more than seeking to get back as much money as they can for their customers, because it's not as if paying for a gigantic fire that consumes 16 years of underwriting profit, if there's no recovery, of course that's going to impact rates.
And I think we're going to hear more of our next meetings about specifically what define help. But when I think about help, I also think about the availability of reinsurance. And we've talked here that there may not be the crisis in the residential insurance market at this point, but over time there might be. And so I'd really welcome the input of insurance companies about how do we stop that future crisis? What role can we play now?
You bet. And it's important to realize also that a company that would write residential property insurance doesn't necessarily get itself involved in big commercial risks or in the reinsurance market. These are different segments and these are different pools of money.
Did you have one
I think
comment?
just to bring this back to mitigation, because I think that's where, we can find the most common ground among all the players here is, I think we all acknowledge that wildfire mitigation research is behind certainly hurricane and flood. And with all due respect to Rex and his colleagues, I think, definitely the private insurers are going to have to be pulled. You heard Florida had to legislatively mandate mitigation discounts. And I will say that, personal chip on my shoulder is that, our organization applied to PG&E along with 2 counties for a pilot wildfire mitigation program. And they turned us down. This was like before the fires. And we thought, well, okay, this was a cheap one. So clearly, I don't know, I think again, the utilities, we all need to be making it easier for homeowners to do their part. And that is going to require some sort of fund, I think, because you're going to have to finance research. You're going to have to finance the equivalent of the brace and bolt program. And the last thing I want to say, just like we talked about the development of a public model, again, we haven't really talked about this whole social discussion around, do urban people, Rex touched on it, do urban people have to subsidize people who are choosing to live in harm's way? A lot of people will say, I didn't choose, I've been living here the whole time. It wasn't, so these are kind of ongoing discussions, but just bring it back. Insurance is a pooling mechanism. So, to a certain degree, all policyholders are somewhat subsidizing each other.
Well, I appreciate that, and also your comments, I think, align well with the other 2 speakers, that even we have other funds, those funds are doing other things beyond just covering loss. They're helping to invest in the R&D, mitigation. And so if we think about a fund and its potential in a broader concept, it seems like there might be a role for the insurance companies.
Yeah, if I could just add on this pooling idea, I would say Rex mentioned that models are great because they help segment and they do help an insurer maybe choose to write some business that they would otherwise turn away. When we get into these pools or models, we end up with much less pooling over time. As you segment to across 30 scores or 100 scores in a core logic model, you are invariably cutting that pool into smaller and smaller ponds until, somebody's just out there in a, baby pool. So, and the rates will be extremely high. So, there are decisions to be made of whether, if we go down some path of modeling or looking at pricing, you don't want to end up with, well, it's now available, but it's not affordable, or we do want to try and keep as much pooling as we can and balance that with, Rex's comments of not making it so insurers won't want to offer the coverage.
Thank you. I have a suggestion for the commissioners because we are woefully out of time, but the point of today is for everyone to hear our questions so that we can get good information and comments for the next few weeks. So let's just go down the row and each commissioner just say now what additional questions you would have liked to ask. We're not going to get answers, but our executive officer can follow up, and maybe we can also get some more feedback, both in written comments and in our last meeting. So Commissioner Ward, what else did you have on your list that you would have liked to hear?
I would have asked you all a question about the Hawaii Cat Fund and funds that are designed to bridge through an interval where we need to increase safety. I'd love to hear your thoughts on that. I would have asked you, in addition, more about how Fireline scores factor into rates, what these factors mean in terms of total dollar cost to homeowners. And I would have asked you to reflect on not so much insurance company contribution, but if there were a insurance policy assessment that contributed to utility wildfire funding of some sort, reinsurance of some sort, whether that raises the same concerns or different concerns, or how you think that could be structured in a fair way, in an equitable way. Some increment of contribution, not the whole thing.
Thank you, and I had the same second question as Commissioner Ward, who said it much more technically than I would have, so I appreciated that. The other question I would have asked is, when we think about reinsurance, and if those reinsurance costs were allowed to be passed through to policyholders, how big is that relative to the actual premium costs now? And what examples do we have from that in Florida that was mentioned? How much did the insurance overall go up once you allow for pass through some of the reinsurance costs? Commissioner Jones, please.
So I think it's just important to level set for a second, and that is, part of our charge is to look at what's happening vis-a-vis the utility sector, the imposition of inverse condemnation is a strict liability standard on that sector. And we've had a panel that focused on that and looked at, their challenges with regard to getting reinsurance, and, we've talked about the possibility of creating some fund to address that. Now we're also looking at challenges in the homeowners insurance market. And we've had a robust discussion of that today, and there's maybe some conversation or interest in talking about some sort of a government-sponsored fund or government-sponsored scheme that would provide additional wildfire insurance for people that can't get it, or that might subsidize its price. And I just think it's important that we kind of make sure that these are related but different things. So on modeling, if I had a chance to ask, I would have liked to ask the panel to explain the difference between modeling for setting an insurance price versus modeling for deciding whether you're going to renew or write the insurance to begin with. Because those are two very different things. The department gets to review the rate filings from the insurers that have the models that have been alluded to by Mr. Lauscher and assess those for their accuracy, veracity, rationality, et cetera. The department does not get the models that are used by the insurers for purposes of deciding whether to renew or write the insurance alone. And as Mr. Frazier appropriately pointed out, those are more granular models, and that's a good thing because it's allowing insurers to make more granular decisions. But I would have asked the panel to explain that difference and explain their views on whether the second set of models, which are the ones that actually look at the question of the underlying fire risk that a particular home faces and assigns a score and decides whether to renew insurance or offer new insurance for that home, whether those models ought to be filed with the department, reviewed by the department, and approved by the department. That would be a question. Second question would be on this issue of research and development around models. I'd be interested in a deeper dive by Florida on how that's funded, whether that's general fund funded, whether that's funded out of some consortium of payers into some fund. I'd just be curious about that. Third, I'd be interested in each of your perspectives on the potential consequences of standing up a government scheme of homeowners insurance at this moment in time, and the consequences with regard to the cost of doing that for the state, the potential for sending the wrong signal with regard to the level of risk, both in pricing and availability, and whether there are things that are short of that, like linking requirements around mitigation to the provision of insurance, that might be a better approach. I'd be interested in your thoughts on that.
Thank you, Commissioner.
I am very interested in the question of whether there is a crisis in a submarket. I take all your points. There's not a crisis, but it seems to me that there are people who can't get insurance or can't get enough insurance. And I would like your views as to whether I'm correct about that. It seems to me chart 9 shows that. And the question I would have is if that's accurate, that there is a crisis in a sub-market, which may be exacerbated by the modeling and the focus that the CAL FIRE is having of identifying 35 areas that have risk. What law changes should we recommend to deal with the crisis in that sub-market? That's the first question I have. Second question is focuses on the comments that Ms. Block made regarding underinsured or people who need to go to utilities for recovery. I'm sympathetic with those people, but I think that they're a subcategory of greater number of people who have fires that occur because of lightning or people who violate the Smokey the Bear requirement. And so my question is, if you would humor me and put all of those people in the category, the uninsured, the people who are victims of the fires but are not receiving compensation, what should we do about that? What recommendations should we make that are not utility specific, but don't rely on the randomness of how the fire was created, but rather focus on the victimization? So I'd be curious as to what law recommendations we can make to address the problem that those people are facing.
Thank you all very much. Appreciate the time you spent with us.
He's an angel for lending me his pen.
And there's a webcast, so you all taking notes like good servants of the community, and we appreciate that. We can actually get those questions to you in a written up format. Next, I'll ask those who are joining our utility financing options panel to come forward. We should have enough seats for those who are in the room, and we've got someone on webcast as well. In the interest of time, we're not going to take a break, but I would encourage everyone who's been sitting there to stand up, to come in and out as you wish. You won't be disturbing us as we move forward.
If you don't mind actually.
And we will take public comments after this session. For those of you who have been attending all of our meetings, you are welcome to make comments today, but also we welcome your comments in future meetings as well.
This chair might be, well, they can switch before we get, but I think it's going to.
Yeah, let's.
Do you want me to slide? Sir, can you stand up for a second?
And panelists, for this panel, as you know, financing mechanisms are a key issue that we're looking at, that the commission is looking at, and we will be doing deeper dives and specific proposals in our April 29th meeting. But given the breadth of options here, we did want to do a panel today to help orient all the commissioners and all of the listeners and participants to some of the options, and then we'll do the deeper dive on the 29th. So given that, my big takeaway is it's not the last time you have to talk to us about this, and appreciate your cooperation with our schedule. So we are going to begin with an overview presentation about financing mechanisms from Carolyn Kowski, who's Executive Director of Wharton Risk Management and Decision Processes Center, just so that we all know the possible universe. So with that, Dr. Kowski, are you on the line?
I am on. Can you hear me okay?
We can hear you fine. Can you hear me okay?
Yes, thank you so much for having me and for accommodating my remote participation. I know that's far from ideal, and literally 5 minutes ago our network went down here, so now I'm on my cell phone instead of a landline, so the hazards of technology. So that's just to say, cut me off if somehow the audio is not working for you.
That sounds good.
Okay, great, thank you. I wanted to tell you a bit about a report we just put out a couple months ago that looked at mechanisms for California's electric utilities to finance their wildfire liability. In this work, we considered funded risk retention, so essentially self-insurance. We looked at the commercial insurance market, at insurance-linked securities, specifically catastrophe bonds, at forming an industry captive, an industry risk pool, and recovery bonds. So I'll just walk through and tell you a minute or two about each of them and sort of where we came out on them. But first, I just wanted to point out, as has been clear from the discussion all day, that financing this risk is challenging, right? It's a potentially catastrophic risk. So there are going to be loss years that are very severe. And when we're talking about the liability risk by utilities, it's concentrated on a few firms in the state, which makes it difficult to diversify. And I also want to point out at the beginning that financing tools don't create money. And that might sound obvious, but the risk has to be paid for one way or another. And what financing strategies can do, sort of two very important objectives of them, is to first allow access to capital in those high loss years. So when you have a severe wildfire year, having access to the funds to pay losses sort of quickly and smoothly. And then the second one is to smooth those costs over time, so that there's not a shock to ratepayers or to the financial soundness of the utility or anyone else. Okay, so now let me just go through and say a bit about each of the mechanisms. So the first one is risk retention. Clearly, firms have to do some of this. We discussed being explicit about the layer of risk being held by the firm, so essentially funded self-insurance, and maybe using a dedicated rate component to build up a reserve account. The challenge is that if fires become so frequent and severe in this state that this could essentially devolve into just an annual contribution to cover those costs. And that still might be useful, but it's different from what you typically think of with a reserve account. If that's wrong and wildfires are less than expected, then you're going to start to build up a lot of funds in the reserve. So you'll have to have a mechanism in place to target sort of what level of losses the fund is for, and then any excess would go back to ratepayers. It's also worth noting that reserve funds tend to work best for, essentially the first layer of risk, but they can be challenging for higher magnitude, lower probability risk. So it can be not cost effective to hold that much capital, or politically difficult, or investors might not like that much cash just sitting around. So there's a bunch of other things to consider when determining sort of what size reserve a firm would build up. Okay, next we looked at the private insurance market and catastrophe bonds. I'm going to talk about these together. Utilities have historically bought some amount of insurance, and this is likely to continue. But right now it seems that the market, and we've heard this already, is not there to really make use of these instruments in a substantial way or to fully cover the growing wildfire liabilities. All the utilities have noted in public statements and public documents that the cost of insurance for them are way up and availability is down following the 2017 and 2018 wildfire years. And indeed, I've heard folks from the insurance industry noting that after these 2 years of wildfires, as recently as last week, I was told that there's a concern that wildfire risk might be changing in the state in ways that the industry is not fully understood, and that a number of firms might essentially be hitting the pause button and rethinking and reevaluating this risk. And we see something similar with catastrophe bonds. So catastrophe bonds place risk into the financial market, and that's thought in theory to kind of be useful for risks that might be too large for the traditional insurance market, and that they might be attractive to investors when they're uncorrelated with other financial assets and could generate a higher return. But of course, the full loss of principal makes these instruments inappropriate for all investors. And as we have seen, if investors aren't comfortable with the risk, and they usually aren't, experts in natural hazards, they're not going to be interested, or they'll demand high rates. So PG&E and Sempra were both able to place small catastrophe bonds for this risk. But we've heard from others that at this point, there's very little investor interest in doing any more third-party wildfire cat bonds. It's a concentrated risk that plays out over a long time period. And these are actually, I think, the only ones for third-party liability that have ever been placed. So sort of summarizing all of this, I think it's clear that there's always going to be some level of commercial insurance that utilities are purchasing, but it's not going to fully cover the risk. And while we did talk to one or two people who were optimistic that maybe, down the road in a few years, there might be some rule for catastrophe bonds to take some part of this risk, in the near term, that's not a viable option either. Okay, so next we looked at creating an industry captive. These are insurance companies that are established by a parent company or companies in order to insure the risks of the owners. They operate a lot like insurance, like an insurance firm, but they only provide coverage to the owners. So this could be an option to pursue a bit more, and there's certainly precedent in the electric utility industry. There's multiple captives in operation today, but you need to do some detailed sort of actuarial study to see, if and how and when it would be cost effective. They have been used historically in different sectors to cover difficult to insure risks and to save costs on risk transfer during hard markets, which might characterize the situation right now, but again, more detailed work would be needed on setting premiums and underwriting and claims adjusting and the capitalization and the management structures and so on. And on the one hand, you'd have to see whether it would actually be cheaper than purchasing traditional insurance. The positive thing on the finances is that in low loss years or no loss years, the premiums could be retained as reserves or rebated back to the company. We also looked at the creation of a risk pool, and I know this has already come up today a number of times, but essentially any interested utilities would pool their risks and be essentially exchanging a share of their own risk for a share in the pooled risk. So the financial resources are combined and losses are paid out of the common fund. This would be member owned and operated. There is, the possibility to maybe tie this through mitigation. Some other types of pools have used, excess funds to actually fund mitigation investments or have some requirements for membership in terms of risk reduction. There's analogs in municipal pools. Municipal pools operate in every state. They were generally created, again, for risks that were hard to insure, often liability risks. California law explicitly says that these municipal pools are not to be treated as insurance, so they're not regulated by the insurance commissioner. I'm not a lawyer, but it seems plausible that that would then apply to any utility pool as well. And again, this is an option that would need some actuarial and hazard modeling. It's not going to be cost effective if the utility is just trading dollars with the pool. And so for that, it's worth noting that pools tend to be a good idea when there's lots of independent risks, because that's when mathematically you get the benefits of risk pooling. But here you might have sort of a few entities and the risks are somewhat correlated in the sense that when you have weather conditions that produce the conditions for severe fires, everyone's going to be facing them. So again, this would require some detailed modeling. And this gets back to the discussion in the Q&A of the last panel about the sort of state of wildfire models. And I'm not a modeler, and I'm glad this conversation's progressing, and what the previous panelist said echoes with what I've been heard, which is that there's maybe a little bit of caution in using these models. They're young, as was referenced, the storm surge models after Andrew have now had decades of development and verification and validation against events. And that's starting to happen with the wildfire models. I was told, for example, that they hadn't really accurately captured how severe winds can really blow embers very far distances, and now they're being updated to include that. It's worth noting that in this context of thinking about financing for utilities, even after the hazard is modeled, you then need to model ignitions related to the utilities and expected damages to the properties and the legal environment. So it gets complicated. And we were told by some stakeholders that that was an issue with the cat bonds as well, that some investors just didn't feel comfortable that the modeling was at a place where it could fully capture that risk. And as you already heard at the start of the meeting, to pursue a pool, then there's a bunch of design questions that have to be teed up and addressed, which, you guys are already asking, but things like who's in it, is it the IOUs, is it all POUs? You were already talking about whether it's mandatory or not. What's the upfront capitalization? How are the premiums or donations set? It probably needs to be based to some extent on risk, size, how are those paid for? Is there a dedicated rate component? What are the specific coverages and the amounts? When does the pool kick in? When does it stop? What do you do with the unspent funds? How big of a reserve? When do you give it back to the company? So there's a lot of, in the weeds work that would have to be done to make a pool a viable option. Okay, then the last thing we looked at was recovery bonds. This was the only post-event mechanism we examined. These are essentially bonds that are sold to investors to fund the damages and then are repaid with interest over time. And I think the one thing to say about this is that you're likely always going to need these sometimes, because any financing situation, you could have a more severe event that sort of exceeds what you designed and planned for, and then this is your sort of post-event mechanism. But you can sort of smooth the process and also make them more attractive to investors if the cost recovery is clear and approved ahead of time. So that's an overview of the different options we went through. And I'm just going to end by saying, and you heard this when talking about the Earthquake Authority too, it's not like there's one silver bullet here that's going to solve the problem. The idea would generally be to layer options together in such a way that creates a cost-effective financing tower and meets the other goals of the utilities and the regulators, which might include things like the degree of control they have over the risk and the distribution of the costs and so on. And this type of layering together of these financing options, as you heard, is something that insurance companies do. The Earthquake Authority did, lots of firms do this. So this isn't sort of a novel problem, but it does require specific analysis of the specific hazards and finances of the individual utilities. It's not always true, but it's sometimes generally the case that it's most cost effective to retain the higher frequency and lower magnitude risks. So that'd be like a reserve account or something, and then transfer the lower probability, higher magnitude risks, whether it's through a pool or commercial insurance or what have you, and then use the capital markets for tail risk. Okay, I'm just going to end now by saying that the report was focused on financing options, but clearly, and this again has come up by a number of people already today, a critical complementary conversation that has to be had is identifying, prioritizing, and then figuring out how to fund cost-effective risk mitigation options. And that includes not just risk reduction investments by the utilities, which is an important conversation, but also for the state, because wildfire for the state of California is much bigger than just those connected to utilities and gets at questions of land use and building codes and all sorts of things that might be, certainly outside the scope of the work we did, that I think is important to flag nonetheless. Thank you. I hope you could hear me okay.
Thank you, Dr. Kowski. For those who are not familiar with her work, she has written extensively on the range of financing mechanisms that are out there. And so we'll make sure to post some of her work on our website. But my big takeaway for your comments is that the mechanisms we're talking about don't reduce the overall cost, but they make it easier to pay them quickly, as well as to pay them over time, perhaps reducing some of the shock to those who ultimately have to pay those costs. And so we'll be looking forward now to hear from our panel about some of the different financing mechanisms that they're thinking about and what they can accomplish. I think it's important for our commission to be able to lay out what are some of the options and what might become more available as we actually do reduce some of the cost and mitigation efforts. So with that, let me invite our first speaker, David Heller, Vice President, Risk Management and General Auditor, Southern California Edison, to offer a few comments on this topic.
Good afternoon, and thank you, Commissioners, for the opportunity this afternoon. I am going to today outline a few of the risk finance options and features that we utilize in our company and that are available to industrial companies and utilities in general. We'll build a little bit on what you just heard from Wharton. I'll try not to make it repetitive. There are a variety of ways to finance risk. Most approaches do involve transferring the risk to another party, like an insurance company or reinsurance company, or, as you heard from Wharton, the capital markets through cat bonds. It's also possible to finance a risk using pre-funding to smooth out the variability of claims costs. I'll describe each of these and provide a little bit of color about what we do vis-a-vis each of these. If needed to satisfy a claim, the insurer, Figure 1 shows the structure of a typical corporate insurance program.
What figure are we looking at?
Figure 1. It should be in your the materials.
Do we have slides for this?
We do not. I apologize. I'll describe it though.
Okay, we'll provide them later.
So this is what you've heard about earlier before. It really is a tower or a layer cake. It was described earlier in hearing. The diagram, the way we described it, first shows at the bottom, and you read these towers from the bottom up, not the top down. First identifies an illustrative $10 million retention, and that would be typically the way these things are built. Then the next successive layers, layer 1 would be the next insurer, and if there were a claim after going through the $10 million retention, the next insurer up would pay its portion of the claim, and then you would go up successively to the other layers as needed. For investor-owned utilities, claims payments made within the retention are forecasted and collected in customer rates, generally using a 5-year average of historical claims. Premiums paid for insurance are also recovered in rates based either on a forecast of premiums or on premiums actually paid. Sometimes insurers include a co-insurance provision. I think we talked about that in the last hearing in their policies. This means that for any claim that's paid by the insurance policy, a portion of the claim must also be paid by the insured company. So for example, if there were a 10% co-insurance feature, that would mean that for every dollar of claims covered under the policy, 90 cents would be paid by the insurance company and 10 cents would be paid by the insured, or the utility in this case. Co-insurance participation is a form of self-insurance and can be funded in the same way as the retention can be on a program. Reinsurance, which you've heard a little bit about, is similar in concept to insurance, but is defined very simply as insurance for the insurers. Non-insurance companies such as ours cannot access the reinsurance markets directly. So the way we do that is by forming a captive insurance company, which you heard about, an affiliate of ours, that is an insurance company and can access the reinsurance markets. We've been doing this since 2013, that is accessing the reinsurance markets directly. The reason we do this is a little bit different than what you've heard. First, there may be a price differential between reinsurance and insurance. In the case of wildfire, that has been the case in the past. It's less so today as the markets have gotten harder and more carriers have left the market. More importantly, the reason we access the reinsurance markets through our captive insurance company is for capacity. And without that reinsurance, we would not be able to get the levels of insurance that we're able to get today. Next, I'll talk briefly about catastrophe bonds, or cat bonds. They're a means of obtaining risk protection from the capital markets as opposed to from insurers or reinsurers. The mechanics of cat bonds are somewhat complex, but in essence, the bonds are issued in the capital markets with the provision that investors, in this case, as opposed to insurers and reinsurers, may lose some or all of their investment if a certain event happens. For instance, a large wildfire, earthquake, or hurricane. I'll just reiterate what Wharton said, and in this case for wildfire, cat bonds are different than the vast majority of those that are placed typically. The first reason is that typical cat bonds are first party, that is they're for property damage, and for wildfire, if they're protecting utilities, they're third party. They're taking care of our legal liability. Secondly, typically cat bonds are not single peril. They are multi-peril, and that helps spread the risk for the investors. And then lastly, cat bonds are typically, they have regional diversity. And in our case, we're focused just on California. So for all of those reasons, just as you heard from Wharton, the availability of cat bonds is much, much less than it is for other perils that are first party. We do think there is a market, and we do pursue that market, and you heard about 2 placements that were already done. The capacity tends to be small with regard to those placements. Next, I'll talk about funded self-insurance, and this works by creating a pool of funds that's available to pay claims as they come due. Contributions are made to the self-insurance fund on a regular basis, allowing for a predictable pattern of funding, and claims are paid from the self-insurance fund as needed. The level of contributions can be adjusted over time as based on claims experience. So if you build adequate reserves, you can reduce your claims or your premium payments. And ultimately, if there aren't losses like there weren't in the CEA examples you've heard about, the retained earnings can go back to ratepayers. In the case of wildfire risk, funded self-insurance makes sense when the cost of wildfire insurance is too high, or to cover co-insurance or the retention part of a program. In our case, it really makes sense for financing wildfire risk in excess of the amount of insurance and reinsurance availability in the market. And as we've talked about before, that is around 1.5 billion is roughly the capacity that we know. While not a substitute for cost recovery under the regulatory framework, which is really the key issue facing the utilities in this particular circumstance, we do believe that a wildfire fund with characteristics which include the following will not only complete the inverse condemnation doctrine that calls for socialization of liabilities, but also would provide an economic substitute for commercial insurance above where the markets can currently respond, that 1.5 billion or so. These principles would apply to wildfire and a wildfire fund for utilities, as distinct from a broader fund. First, there should be a governing board appointed that would include participation from IOUs and POUs, and this board, amongst other things, would make decisions on utility contributions, reinsurance, other means to reduce ratepayer impacts. The IOUs and POUs should be required to continue purchasing commercial insurance to the extent it is economically feasible to do so. In fact, that would serve as the retention for the fund. The fund should respond and pay claims for property damage once an individual utility's retention has been paid. Importantly, a fund must avoid the moral hazard here. The CPUC should retain authority to fine and penalize IOUs for conduct or regulatory violations related to a fire. For a wildfire covered by the fund, the way we see it is that IOUs would pay additional premium upon a loss to recapitalize the fund. And that additional premium would be subject to a prudency review by the commission, who would then determine what the additional premium, the payback to the fund would be, and how it would be allocated between shareholders and ratepayers based on the prudency of the conduct in the specific fire. And then lastly, willful misconduct and punitive damages would not be covered by a fund. Fifth, the wildfire fund should be funded by electric utilities' initial and ongoing annual premium contributions. As you've heard this morning and now this afternoon, premiums should be based on risk. That could be the miles of distribution or number of meters in high fire areas. That's one way the modelers take a look at things today. And then, of course, should be backed up by modeling and actuarial analysis. Initial and annual premium contributions to the wildfire fund should be covered in rates, just as insurance is today. And then last, electric utilities should be able to securitize. That's the post-recovery bonds that you heard Wharton talk about, with a dedicated rate component, the initial and ongoing annual premium contributions, and if necessary, post-loss premium, at least that portion that is paid for by ratepayers based on prudency. We've done preliminary modeling of the fund, and we used a 10-year horizon. It indicated an initial contribution of $2 billion with an annual contribution of $700 million would be sufficient based on the following assumptions. And as we've talked about before, these assumptions can be changed, of course. First, a $500 million retention, meaning that it presumes that utilities carry at least $500 million of insurance. The maximum payout that we ran the model on was $20 billion per occurrence and $30 billion in the aggregate for any one participant in any one year. The fund could securitize revenue from utility premium payments if needed due to a loss. Again, that's the post-recovery bonds. Premiums increased for 5 years following a loss to the fund, primarily paid by the loss-causing utility. So this is a way to, again, recapitalize the fund, and there's an additional premium for the loss causer. Wildfire claims are settled over 5 years. You get the time value of money. And then we assume that subrogation claims would be settled at historical levels, which are about 50%. I'll pause there and turn it over to the next panelist, but I look forward to answering your questions on the fund and other questions that maybe came up earlier that are relevant to our panel.
Thank you. In the interest of being really specific around terminology, sounds like when you're talking about a fund, you're talking about some type of pooled reserves. Would that be the right, accurate way to say that?
Yes, it's a funded self-insurance pool is really the way it would be characterized. It could take several different forms, but yes, that's in essence it.
Thank you very much. Mr. Tony, welcome.
Thank you very much. I'm Mark Toney, Executive Director of TURN, the Utility Reform Network. And what we're here to talk about today is the inequity of a system that relies on ratepayers to pay for wildfire property damage, okay? It's the most regressive way of charging to pay for something is when you charge for consumption, when you tax consumption, because the difference between consumption of energy between high-income households and low-income households, while it exists, is not very much, okay? The gap between wealth is far more than consumption. In fact, California exempts essentials like groceries from sales tax because of the recognition that taxing consumption is regressive. So our proposal is that California set up a form of catastrophic wildfire fund that is paid through property insurance surcharge as a proxy for wealth, okay? And that it covers all wildfires regardless of origin. I think there's a lot of recognition that utilities are not the only causes of wildfires. We had the big fire in Redding this year, the Carr Fire, which CAL FIRE was very clear had to do with a vehicle trailer hitch, nothing to do with utilities. And so as wildfire risk, as the damage grows from wildfire damage, we would like this commission to develop solutions that address all wildfire damage. One thing about ratepayers is ratepayers are already being asked by utilities to pay billions of dollars for wildfire mitigation. And I think that there is a recognition that utilities need to do a whole lot more to prevent wildfires from starting in the first place, and for identifying and making sure they're put out very quickly when they do start, so that we don't have these major capacities. That is a far more sensible investment of ratepayer money than paying after the fact. It just makes sense that if you're paying for property damage, it belongs in the property insurance sector. That's what pays for property damage, okay? Property insurance. Now, one thing I'll say is that it's very important that our idea of this fund is that utilities would not be off the hook if there's a wildfire caused by utility negligence, by failure to comply with the rules. If an investigation finds that they are responsible for starting a fire, their shareholders would be responsible for reimbursing the fund. It may be over time, they may securitize that, but the utility does not get off the hook. That is very important. The situation we have now is untenable because if a utility is not negligent for causing a fire, they can recover their expenses through the CPUC process, and recover means from ratepayers, okay? Certainly any amount that's over their insurance coverage. And because of SB 901, there is a liability cap that's set, which applies even if there is a fire and damage caused by negligence. We are asking this commission to make sure that there is a thorough vetting of a catastrophic wildfire fund that relies on the property insurance market to relieve the burden of ratepayers from paying for property damage so that we can make needed, reasonable, cost-effective investments in wildfire mitigation, stopping those fires before they start. Thank you.
Thank you, Mr. Tony. Mr. Fisk?
Yes. Good afternoon. Is this on?
I don't think so.
Good afternoon. My name is John Fisk, and I represent wildfire victims in the 2015 Butte Fire, 2017 North Bay fires, 2017 Thomas Fire, 2018 Woolsey Fire, and 2018 Camp Fire. I represent thousands of individuals and businesses, and I am lead counsel for the following public entities: Sonoma County, City of Santa Rosa, Napa County, City of Napa, Lake County, City of Clear Lake, Mendocino County, Yuba County, Nevada County, Calaveras County, Butte County, Town of Paradise, Santa Barbara County, City of Santa Barbara, Ventura County, City of Ventura, and several special water and fire protection districts. And if I come back here, I won't do that again. My comments today will focus on the interaction among IOUs, shareholders, wildfire victims, ratepayers, and the state during potential fund formation and access. It is important to note that my clients are also ratepayers and taxpayers, in addition to wildfire victims. I supplement my comments with a 3-page handout outlining just one conceptual model. And although it's not going to win a Nobel in economics anytime soon, it is just one example of several models under consideration by several stakeholders. Today, I will attempt to ask and answer 3 questions broadly. First, how can IOUs contribute to a comprehensive fund in a way that balances shareholder and ratepayer interests? 2, how and when should IOUs access these funds? 3, how and when should IOUs reimburse these funds? 1, how can IOUs contribute to a comprehensive fund in a way that balances shareholder and ratepayer interests? IOUs should contribute to a comprehensive fund in 4 ways. First, IOUs should increase self-retention deductibles. For example, the first $100 million of a wildfire liability. Increased deductibles incentivize prudent management of electrical assets and reduce burdens on ratepayers who ultimately pay insurance premiums. Second, IOUs should increase liability coverage. Each IOU should carry a minimum of $3 billion of wildfire coverage. Premiums on mandatory minimums should be supplemented by the state or shareholders to protect low-income ratepayers. Third, IOUs should contribute initial capital borne by shareholders, not ratepayers. Initial capital would be in addition to state catastrophic bonds, tower insurance, and other funding mechanisms. Fourth, IOUs cannot reimburse funds when drawn for negligent liabilities. Fourth, IOUs can and should reimburse funds when drawn for negligent liabilities, Two, how and when should IOUs access these funds? IOUs and wildfire victims should jointly petition the state to access funds. Victims can proffer threshold evidence, such as CAL FIRE reports or findings, or other evidence to qualify and justify fund access. The state should not require IOUs to admit fault or liability, as such would interfere with the usual and customary civil, criminal, and regulatory processes, and therefore make fund access impractical and inefficient. IOUs should have access to funds no later than 2 years from the date of the fire. Most personal insurance policies offer coverage called Alternative Living Expenses, or ALE. ALE provides wildfire victims money for alternative housing. Most ALE coverage expires within 2 years after the date of the fire, although some policies are 1 year, after which families are left without financial support. Public entities need funds for urgent public works and infrastructure projects, such as water systems, roads, parks, bridges, stormwater culverts, soils, and land rehabilitation. Thus, an IOU should have access to such funds well in advance of the 2-year anniversary of the fire to help communities rebuild. 3, how and when should IOUs reimburse funds? Shareholders should reimburse funds if IOUs are found negligent. To the extent the fund includes state, taxpayer, or ratepayer resources, such funds should not subsidize negligent liabilities in a manner inconsistent with current CPUC socialization policy. However, the standard for CPUC socialization should be clear and congruent with current civil law. Lack of clarity in CPUC standard creates uncertainty for IOUs and investors. One suggestion is to match CPUC standards with current civil law to provide such congruence. Should the CPUC find that an IOU did not act negligently, socialization would be appropriate under California law, and thus shareholders would not bear the burden of reimbursement. In conclusion, 5 minutes is not enough to complete this conversation, but I hope some of my comments will help guide this commission to protect wildfire victims when contemplating fund concepts. By contrast, trying to eliminate wildfire victims' constitutional property rights will not fix this problem, but only exacerbate an intense political fight, preventing cooperation towards progress. However, it is important to conclude with the reminder that the only way to eliminate market uncertainty, insurance strain, victim devastation, taxpayer waste, and ratepayer increases is to prevent utility-caused wildfires from happening at all. An ounce of prevention is worth a pound of cure, and any comprehensive statewide plan must include de-energizing policies, recloser policies, compliance with current vegetation management laws, and hardening of current aging infrastructure. I'm happy to answer any questions the commission may have, and I thank you for your time.
Thank you very much. And next we'll hear from Steve Fleischman. We've asked Mr. Fleischman, he follows what's going on in the markets, and to give us some insight into what equity and bond markets might think about some of the things we're hearing about now, and generally how to think about this notion of financing mechanism. So welcome.
Great, thanks, Madam Chair and Commissioners, for inviting me to speak today. So my name is Steve Fleischman. I'm a sell-side analyst. I cover utilities and renewables and power companies for a firm called Wolf Research, which is an independent research firm. I've been doing this for 28 years and have covered the California utilities for 28 years. And just so you know, I don't actually own any utility stocks. I deal with the investors that invest with them and converse with those investors. And, so a lot of the large owners of the stocks are my clients. I appreciate that this topic is a matter of life and death and much bigger than just investor impact. And my expertise really here is obviously just on the investor point of view. And I'll describe in a minute, I do think there's great mutual interest in a better framework for addressing future utility fires for all constituents. So just as background, in my experience, utility investors are generally seeking companies that provide stable income and modest growth. Utilities are able to earn a fair return on their investments, but their return is essentially capped. Warren Buffett once said, utility business should be a good business, not a great business. And investors are not seeking big upsides out of utilities. But they also expect to have limited downside risks. California has historically had a regulatory environment that allowed for this balance. While rate cases, we often complain, are a little too long, the utilities have generally had a chance to earn a fair rate of return on investment with manageable risk. And when utilities have had big issues in the state, they often have been self-imposed issues. This time is different. We think the mix of increased fire risk, the unique application of inverse condemnation to utilities in this state, and the lack of clear and timely recovery creates an overwhelming downside risk for utilities. It is comparable to utility having the risk of a failed multi-billion-dollar nuclear power plant every year, even though the utility doesn't own any nuclear power plants. This high risk and low reward skew is not one that works for any utility investor. It really doesn't work for any investor to have a capped return, but have the risk of multi-billion-dollar liabilities that they're not sure that they can recover. So we also believe that the current framework is untenable, and we've called the California utilities uninvestable. And all the utilities could be junk credits with worst case risk of bankruptcy in the event of more catastrophic fires. So the obvious question is, why do investors own stock in California utilities at all today? And the main reason is they think their current situation is so untenable and unsustainable that it must get fixed before the next fire season. The formation of this blue ribbon panel and comments from Governor Newsom have been encouraging to investors. But it's not just about utility investors and their risk returns. Most utility investors also look much more broadly to the constituents in the state to get a sense whether they're happy with the companies, the rates, the regulatory environment overall. And when most parties are happy and working together, when there's a balance, investors feel more confident that there's a sustainability in the utilities outlook. That's clearly not the case in California right now. The extreme downside risks due to utility financials, due to more fires, inverse condemnation, and lack of clear and timely recovery is hurting everyone. This framework is not just untenable for utility investors, but it's untenable for most, if not all, the key constituents involved. Wildfire victims need to be certain they can be paid for current and future fires outside of a federal bankruptcy court. Renewable suppliers need to know they will be selling to utilities that are financially healthy, or they won't invest in any more projects. Utility customers and businesses need to know there will not be risk of rate shocks due to financial instability. Utility employees and union members need to feel confident in their jobs because their work is very critical to make California safer. And utility creditors and shareholders need to know that they can lend and invest money to the utility to support very important investments in wildfire prevention, clean energy. With confidence, they'll get their principal back and earn a return. The good news is the solutions here we don't think are rocket science. And I don't have a bunch of details with the exact solution today, but there's a core framework in place that money needs to be available upfront in the event of a future fire with clear certainty to all the parties, no matter the circumstances. Whether this is through a wildfire fund or some other mechanism, there must be confidence that the money is there. And all parties need to help in structuring the fund. We do think it may require state backing or funding of some sort to give confidence. Certainty can't come from the utilities alone, in our view. The solution has to be durable, sustainable, easy to understand, and not subject to many conditions. Utilities cannot be held to a perfection standard, but what happens if the utility did something wrong? The PUC or other bodies should have the ability to assess meaningful fines and penalties, or even review whether board and management changes are required. However, the utility investor cannot be subject to paying billions of dollars of fire damages every time there's a large fire that had one violation. The simple fact is there won't be any utility investors left in the state. There's 49 other states to choose from, and this current risk award just not, it's just untenable. So thank you for your time.
Thank you. Commissioners, I do not want to shortchange the public who we're going to hear comment from, nor the panel with community representatives. And so I'm going to request that we do this. Like we did with the last panel, I'd like to go down the line and have everyone say, what are the questions you would like to hear answers to? And if we have time at the end, we'll circle back and hear responses from the panelists, because unfortunately we do have a hard stop in leaving this room at 2 o'clock. So I apologize for the circumstances, but appreciate your willingness to work with the schedule. So let me start on the right this time with Commissioner Khan. What would you like to hear at some point?
I'd like to hear a different report. Besides that, I'll pass because I'd like to hear from the community.
So I'll direct this to all the panelists, but I think it's more directed to Mr. Fisk and Mr. Tony. If I understand it, we're proposing a fund that would not just cover the utilities losses above a certain amount of self-retention insurance, but would also be made available to wildfire victims. And I just pose this question really to anybody that's proposing a broader fund for wildfire victims. And that is, if I'm a homeowner in a high-risk fire area and I know that there's a government fund that I can go to recover my damages, why do I buy homeowners insurance? That's my first question, right? Then I guess my next question really goes to the same individuals, but also anybody that's proposing such a broad fund. What is that going to cost the state to set up? Because, I mean, the Florida Citizens proposal that we heard about earlier was essentially funded initially by a fee or a surcharge on all Floridians, which makes some sense because hurricane risk probably reaches most people in Florida. But in this state, we have a very different set of factors. We have some people living in an area where there's a high risk of fire, and then we have a lot more people living in an area where there isn't a high risk of fire. And so what's it going to cost to actually capitalize a fund that would be available for fire victims that would basically supplant insurance? And who's going to pay for that? Those are the questions.
I appreciate anyone who's proposing any kind of a fund to explain the basis or the size of the claims paying capacity and provide a rationale for that capacity and that claims paying capacity. And if you have an opinion about what it should be, if you haven't proposed a fund, I'd love to hear your opinion. And also, related to that, and this sort of goes to what Commissioner Jones just said, can we solve the utility problem without covering underinsurance? Does that need to be part of the fund in order to create financial stability for the utilities? And if so, how much does that increase the need for claims paying capacity?
Dr. Kowski laid out several different financing mechanisms that the utilities can take advantage of, and Mr. Heller identified how you currently are utilizing many of those mechanisms. I'd like to better understand, are there any other actions the state could take that would increase the availability of some of those other options beyond a reserve fund, the self-insurance fund? And is there a point at which we get to a certain lower level of total cost that would make some of catastrophe costs, that would make some of those options more available as well? My next question, again, a lot of these are you, Mr. Heller. You identified several mechanisms, but it wasn't clear to me at the end who pays for those. So when you talk about, for example, the retention, is that ultimately something that ratepayers pay for, or do shareholders pay for that? And so for all of what you're recommending, really understanding who the risk transfers to from all your suggestions and who bears those exact costs. And then my final question, and maybe this is somewhat for Mr. Fleischman or others to think about, which is, how does a utility's overall market capitalization affect their ability to contribute to any one of these solutions? You know, we have circumstances where you have utilities with higher capitalization and others who are bankrupt. And what is the interaction with some of these mechanisms? Thank you all very much. We look forward to a deeper dive on the 29th. Next, we are going to turn, if the local representatives would be so welcome to sit here at the front, but I'm going to take with a couple of folks identified who want to do public comment. So we're going to take those first and then use the remainder of our time to hear from our local representatives. Thank you so much again for joining us.
If I can say, myself and my colleague, two supervisors, we're both sitting on the next meeting, which is Local Agency Formation Council. We're going to ask them to start about 15 minutes late to give us time, okay?
Oh,
Thank
bless
you.
you.
Yeah.
I wish I had talked to you half an hour. Okay, no, this is.
Well, I waited for your guys not to be able to answer before I announced that, right? So you can take the time with the community.
Let's hear, I've got two public comment cards. Let's hear from members of the public first. I ask that you keep your comments to under 3 minutes if possible, and then we'll hear from the local representatives. So first, Mr. Abrams, please welcome, and let me thank you for the written comments that you submitted. Oh, welcome.
Thank you. Thanks, commissioners. I appreciate it.
Sir, can you make sure your microphone's on? You press the button or speak. I'm assuming there's a button. Okay. Or speak a little more directly to the microphone.
Okay. Not sure where the button is.
Turns out it's over here.
Just start? Okay, all right, I'm good?
Yeah.
All right, thank you. So I really appreciate the work of the commission. I think as just a member of the community, as I go around and trying to understand how my family and my communities can be protected from the next wildfire, what I see is a lot of great work in a lot of great areas of our government, but sort of tying all those pieces together is what's going to be an informed strategy moving forward is so critical, because then folks like me can figure out how to plug ourselves into that overarching strategy. So I appreciate the work of the commission. I would say on the insurance front, I think there's a real opportunity here for collaboration. I think part of what we heard is what's going to mitigate my risks as a family member to the health and safety of my family are going to be also those same things that are going to mitigate the risks of the insurance company. And so I would encourage the commission to look for that common ground. Specifically, that's sticks like building code and things like that, but it's also carrots. So there's a great model in Boulder, Colorado, Wildfire Partners, that looks to provide those incentives. It's not something that's going to be cookie cutter that can then be presented here in California, but that combined with things that we've done around incentives for energy efficiency and things like that, we can look at those models, put them together, and work collaboratively with the insurance companies to mitigate their risks, mitigate our risks, health and safe communities, and financially viable communities as well. I'm also a party to the motion for the CPUC, and certainly really critical of the plans that the IOs use to put forward. These are primarily financial risk avoidance plans. And so I really think that in order to get them into the framework where they need to be, we really need to make sure that we're focused on motivating them to get the ratepayer reimbursement. So this is not an or question. This is a what can we do to make it an incentive for them to mitigate the overall fire risks and then get paid out by ratepayers based on the amount of risk mitigation they have done throughout their system. And so once we tie those two things together, then they will be able to move forward, make a good return on their investment for their for the folks who are invested in them. And therefore, again, that win-win scenario where what's good for the IOUs is also good for the community members. So I would look to those types of win-win. I have more detail in my proposals. I'm happy to go into any detail if you have further questions as you look through those as you move forward with your deliberation. Thank you.
Mr. Abrams. Next, we'll hear from Kendall Jarvis, followed by Thomas Ellis.
Can you hear me? I don't think this thing's on, but that's cool. I can speak loud as long as you guys can hear me.
Yeah, can you
speak louder?
Yeah, we're just making sure I get right into it. I'm hoping that may go through.
Hello, testing.
All right, well, right, please go ahead, appreciate you, talk as loud as possible.
Absolutely. Hi, my name is Kendall Jarvis. I'm a disaster relief attorney for Legal Aid of Sonoma County. I was actually speaking to Supervisor Gore just a little bit ago earlier today about some of the issues that he's going to touch on from a high level. I'm touching on from a sort of more an interconnected level in terms of on the ground kind of stuff. So we're sort of doing this backwards, but it will make sense either when I say it or after you hear from him or potentially both of us. But one of the things I've had the unique opportunity to do in this position and role is really be on the ground and be able to see patterns that basically survivors face. And while I could go on about these things for hours and hours, I know we're on a very brief window of time here. So two of the one main thing I want to touch on is the issue of underinsurance. And I see that as a twofold problem. Number one, fixing the system as it stands now, and number two, requiring adequate insurance moving forward. The issue of requiring adequate insurance moving forward is complex, but the most simplistic way to do it and what has worked in other states and other countries is to provide a level of gap insurance, where you're not providing like the California Earthquake Authority, where you're providing the whole policy, you're just providing an addition. So I have my homeowners insurance policy, but I can go to the state or to the private market to purchase gap insurance. It says, when there's a disaster and I have a shortfall, I can turn to the second product to make up that difference. So you can keep the cost down, you cannot put all of the pressure on just one insurance policy or the small number of people that can provide it, but you can open it up to a larger market and or bring in the state to basically maintain and oversee the use of that kind of process. The other issue is fixing the system as it stands now. So one major problem is that insurance companies have been able to hide behind their lack of fiduciary duty for a very long time. And what I mean by that is because the insurance industry doesn't owe a fiduciary duty to the consumer, it's been very easy for them to say, look, I'm sorry you chose your coverage, but too bad, it's your fault. Basically, you saw the number, so there you go. When in reality, that's not what happens. The insurance agent chooses the coverage. The individual goes to the insurance agent and they say, hey, I'd like to purchase a policy. What they're asking is to insure their whole home. They're not asking to insure 50% of it. They're not asking to insure 75% of it. They're asking to insure 100% of it. And the agent, because they're in the business of selling insurance policies, says, absolutely. We have a great company. We have great products. We'll get you great coverage. So the representation that's given to the individual in that situation is that they ask for full insurance and the agent has an interest and will provide them with full insurance. This then goes on further. When they receive the policy, after the agent has chosen the coverage amount, the policy says, I will provide you with replacement cost coverage, extended replacement cost coverage, and or building code upgrade coverage, also known as ordinance and law coverage. Those coverages, as stated by the policy terms, are designed to get you your house back without accounting for depreciation up to the current code standards at the time of reconstruction. What nobody tells the individual after the agent has represented that they have provided full insurance, the policy has re-solidified that interpretation and understanding of the process. No one has told the individual that none of this is true. It is all completely false unless your base coverage age dwelling is sufficient and adequate to begin with. The consumer did not choose that coverage. They weren't aware of the burden that was placed on them that is hidden in multiple pages within the policy that they unfortunately just don't read thoroughly enough. So this needs to change. The other reason it's a problem is there are currently no individual enforcement mechanisms. It is nearly impossible to get a private attorney to take on many of these cases because the way that the system is set up currently, unless you're in a position where the amount in controversy is $500,000 or more, it's not in the best interest of a private attorney to take on that case. They're not going to risk $200,000 in litigation for potential recovery of maybe $90,000 to $120,000. It doesn't make business sense and it's not cost effective. So for that reason, using the legal system is not the best way to affect change in this capacity. Additionally, while you can go to the Department of Insurance and file a complaint, that is not as helpful on the individual level as it is on sort of the future big picture level, right? If I file a complaint to the Department of Insurance, we'll go and talk to my insurance company, they'll come back and they'll say, please talk to this person, do you agree or disagree? The insurance company, there's nothing that forces the insurance company to do anything. So it doesn't go far enough in placing basically a requirement that the insurance company do what they're supposed to do. There are laws and regulations in place that we can use to ensure that these issues are resolved, they don't go far enough, but even as they stand now, they're not enforced enough, and that needs to change.
Thank you very much. Next, we'll hear from Mr. Ellis. I'll say we have now a surge of public speakers. We've got 10 now. So I'm going to ask you to keep your comments to 2 minutes as much as possible. Thank you. I think we might run a timer, but I will just be general and soft about it. But sir, please, welcome.
Good afternoon, thank you. I'm returning right now from the federal district, actually the Federal Disability Court in Santa Fe, where I represent disability clients. It was very difficult to get here today, this afternoon. We just heard about this meeting yesterday in the Board of Supervisors, and I'm thankful for that, but I'll get directly to my point. I'm a civil engineer, registered civil engineer in the state. All state planning, all county and city planning must be under the direct supervision, if you will, of a civil engineer. So this planning effort must fall within that at some point. Not your gathering, not your information gathering, but how that gets translated into a product. So that's state law, do forgive me. I have a Master's of Science in Finance, a Master's of Science in Administrative Law, and I'm a registered civil engineer. I was a bond investment broker for many years. 4 years as a civil engineer. Investors must be the corporate overseers of their own corporation. That's why they're required to pay when there's errors. Are these omissions? Was San Bruno, and I'm not, this isn't just about PG&E, it was my relatives who it was, I believe it's Charles Eels, that was the lawyer that was the founder of the corporation of Orrick and Harrington, Harrington, something before that. And that was the Livermore's who created PG&E, so it's not just PG&E.
Mr. Ellis, I want to make sure we get your main point, so can you
Right,
jump to that,
it's not about PG&E per se. Corporations have to be the people that are responsible for the shareholders have to be responsible for their own corporations. It was John Livermore who was the owner, essentially, and ran PG&E until he died about 10 years ago. He was chairman of the board of Newmont Mining. So he did other things, but
I'm going to have to ask you to wrap up, so do you have any final comments?
I do that it's necessary to take the available waters that we have, various water, and put it out into the environment in order to protect and preserve and prevent fires. So you're talking about cost recovery, and make no mistake, there's a lot of cost recovery and how that can, and believe me, portions of that have to be put on the shareholders and the insurance. So again, I'm a third generation civil engineer, and we've involved these things with the insurance companies. Insurance companies were mutually owned. So the insured person had the interest in owning the corporation of the mutual insurance company. And the salesman then, that was an interaction in which they had a mutual interest. They do not have the same interest anymore. There's a corporate shareholder that has that interest, okay? That separation causes a fundamental disconnect with how either one of those entities, whether it's PG&E or whether it's the insurance company, is operated for the benefit of the shareholder and not.
Mr. Ellis, I'm gonna have to move on, sir, but we appreciate your
Those are
comment.
not cost recovery issues. Thank you.
So, sir, we need to move on to other speakers, but as I said earlier, we continue to take written comment, we'll have future meetings, but in the interest of hearing from everyone, we'll need to move on.
Yeah.
Next, sir, I'm gonna have to ask you to step back. Next, we'll hear from Ms. Donahoe, then Terry McBride, then Lisa Frizzy. I think I said her name right. Welcome, Ms. Donahoe. You have up to 2 minutes. Thank you.
Thank you, Ms. Peterman, and always a pleasure to be before you. I enjoyed Reading so much. In Reading, I mentioned to you that we have a great deal of fraud going on here in our community because Business and Professions Code 7159 creates contracts that are not serving consumers and protecting their needs. And that's a CSLB enforcement issue that really does need to be addressed because it's taking a large amount of money out of our community and not building homes. We also talked about the subrogation and inverse condemnation issue. The inverse condemnation can have a backfire, unintended consequences, so I'm very concerned about taking that away. And I asked you to keep looking at subrogation as a bar for State Farm and the other big insurance companies to be subrogating against our utilities and then taking the money out of the state to build their skyscrapers in Chicago. And I asked you to follow the profits. I gave you a sheet from Verisk Analytics showing that they made $34 billion of profits in the first half of 2018 on these disasters using software technology. And I would like to explain to you why it's important, as Kendall said, that people know what they're buying. We need some truth in insurance. And I've made a little diagram for you here that I'm going to pass up as well that shows that Verisk is creating a software tool called 360 value or ISO value that does a zip code calculation for zip code is the location, and the square footage is where the policy is issued. Agents have 10% leeway on that. Then after that, they use the exactware tool to deflate the value of construction. So they're invading real estate valuation and they're invading construction costing, and the construction cost is actually far greater. So it's kind of showing a policy issuance from the agent, estimating from the adjuster, and actual cost from the construction. So Verisk is making a huge amount of money, and they're saying they're doing that for the insurers using these software tools. They're not working for California. They may work elsewhere, but I just talked to someone who does Xactimate, and he says it doesn't work anywhere in the country, and we need to examine insurance technology.
Thank you very much. Next, Terry McBride, then Lisa Frizzy. And I've asked Eva just to run the clock, just so folks can get a sense of your own timing, so you're not having to look at me.
Thank you
Yes,
very much for having us here. I am a survivor of the Butte Fire 3 years, 205 days ago. I still live in a camping trailer because PG&E has not decided to go hide behind the skirts of a bankruptcy court, not be responsible for the damages that they have caused, the lives that they have basically ruined in our little county. We lost over 500 homes, we lost over 1,000 buildings, of which over 500 were homes affecting thousands of people. I would say, if you go to the store and you rob something, your mom or your dad are gonna whip your bottom, and you're gonna get in trouble. Well, let's start doing that at PG&E. How about instead of them giving all their higher ups bonuses, how about getting work done so that things don't burn? How about if you're going to say, oh, hey, we caused your fire, I'll be done in 2 minutes, I know.
Sorry, I think you're fixing my hair.
No, it's okay, honey, I know you're tight. Hey, we caused your fire, we'll go ahead and we're to settle all claims. I lost 3 houses. Two of those were rental. I also lost a nice little camping trailer. Some folks had very little money, could afford to live in, and we kept it nice for them so they had a nice place to live instead of a tent. And I had 2 other rentals that had outhouses, outbuildings. We do have toilets up there, I don't know, outhouses. Anyway, so they burned, and I had a loss of 36 acres of trees. The amount that they settled with me is maybe I can build a house, but I can't even get that because they aren't honoring that agreement. And the only reason I agreed for that ridiculously low sum to an insult was because they were threatening to go bankrupt. And I'm going to put this out there. You cannot tell me they didn't know they were going to go bankrupt months before they finally did, and they forced us in there threatening they were going to go bankrupt so they can force us into pathetically small sums of money, and then just, oh, sorry, too bad. And I wish that you could go see the people up there whose lives have been devastated, that walk around with vacant looks, some of them, because they don't know what to do, because even though the amount wasn't good enough, they could start rebuilding their lives. Thank you for your time.
Thank you. We're sorry for your loss. Thank you for sharing your experience with us. Lisa, welcome. And she'll be followed by Stuart Funk and then Janet Leeson.
Hello. My family and I lost 2 homes in the Tubbs fire. And I first want to thank the committee for taking the effort to holding this in our community today. I really appreciate the fact of you coming out and taking that time. I've taken time, in fact, I sat with Mr. Jones a year ago in Sacramento on insurance issues. And I just wanted to bring up a few points that I haven't heard today. One of them is not only are we geographically being singled out, so if we want to go back and rebuild in our homes, we're being singled out personally. So in other words, if my husband and I decide that we can't rebuild and we want to move somewhere that's not as hazardous, is a better word, of where we lived before, we are seen as a bad risk. So that is something I haven't seen, I haven't heard. So I would like that to be addressed. Also, I think there needs to be addressed when the people were up here, the insurance people were up here talking, I heard two separate ones talk about pre-loss and prevention. And my husband and I, in trying this rebuild process, are trying to look at avenues to not only harm our home, but use maybe a material that won't burn, or a material that's better in earthquake, because we have both issues, of course. And we hit nothing but roadblocks. You know, unless you're gonna build with wood frame, it's more expensive, and it's really hard to get the permitting to go through. So I would like you to address that as well, some type of either incentives or even help or information. We're having to find all the information out ourselves unless we just want to do wood frame. And obviously in fires, this is gonna be more and more common. That's not the best way to go. Thank you very much.
Thank you very much. Just one quick question for you. You're talking about being singled out, you mean in terms of insurance availability?
Yes, well, not availability per se, but, well, yes, actually. There wasn't one insurance company that wouldn't cover us. And also, basically like a bad driver, our rates would go way up. And it isn't our fault the wildfire happened, you know, and so that really shocked us. We understood that our house, you know, yeah, geographically where our old house was, but it seemed like if we moved away from our house, you know, we never had a claim on our insurance. We had the same insurance agent for 26 years.
So the risk
We never had one claim, but the risk follows us even though I felt like we were good, you know, we did what we were supposed to do.
Did you move out of the wildland over your face?
Yes, we are, the home we're in now, we did buy a temporary home, the home we're in now is out of Woody.
The one that you're trying to insure?
The one that we tried to insure with the one agent, the one insurance company was out of Woody, yeah.
Okay, thanks.
Thank you, ma'am. Stuart Funk, Janet Eason, followed by Nora Sheriff.
Thank you for your time. I'm gonna forego what you've already heard before, which is complicated to say the least. I would say we're today kind of chasing a fire that's already happened versus stopping the fire from happening. I watched the Atlas fire start on PG&E equipment. It went 40 knots and killed 4 neighbors. And the policies, I'll call it the politics of forest management, has really been an issue. The wildlife management in Napa County now has a setback. We just passed an ordinance that says you can't touch 70% of your land or 40% of your brush. And even though there'll be some mitigation for fire protection, I can tell you 100 foot around your house isn't enough. So we were disallowed to clear brush around our houses or around our property in favor of a snapdragon or a ceanothus bush. There are technologies that PG&E knows about, they're available. San Diego uses them. These are reclosures that are a lot smarter than what PG&E are installing currently. She's handing you a photograph of PG&E's repair job on the telephone pole.
We'll make sure it's shared.
Thank you. And that basically is their attitude on proper maintenance. The fair plan is not the answer. It's too little. It's under insurance. We're already underinsured. I don't know anyone that's confident that they can buy insurance in the future, or as happened in the past, the insurance companies won't redline these areas once you have your home built in the future. So I would say to look to forest management first, PG&E at the same time as far as prevention, rather than trying to chase it through a number of other insurance products.
Thank you, sir. Ms. Gleason.
Good afternoon. Thank you so much for allowing me this opportunity. One of the issues that I would like to address is something that I haven't heard a lot about. I was personally affected by the Tubbs fire and lost, my family lost 3 homes. And that was enough. We were underinsured. Actually, fortunately, my daughter was adequately insured. But one of the things our community is now facing, we had a neighborhood of about 25 homes, is the private infrastructure that was essential to our neighborhood was either damaged or destroyed by the fire. And that additional financial stress is either preventing or may prevent some of my neighbors from rebuilding. We had, and it's not just our community, but there are a number of communities within Sonoma County that lost bridges that were combustible. Ours cost our community $320,000 to replace, which is a tremendous financial burden for homeowners. In addition, there were retaining structures that were lost. And during the debris removal, these rural roads that are designed for passenger vehicles were subjected to tremendous loads of debris removal trucks. Our road in particular was paved, and it is no longer paved in some sections. So again, we're looking at, as a community, $500,000 or more in private infrastructure replacement, none of which is covered through insurance, nor was we received some money from FEMA, but FEMA's contention was you had a wooden bridge prior to the fire, therefore we will replace a wooden bridge. And we are also running into difficulty with our
Please, I'm gonna ask you to wrap up, I'm sorry.
yeah, there are government programs that are available, but we don't fall into the box. So we're running into frustrations from that.
Thank you very much. Nora Sheriff.
Thank you, Chair Peterman. Good afternoon, commissioners. Good afternoon, colleagues. My name is Nora Sheriff. I represent the California Large Energy Consumers Association, or CLECA. CLECA is a organization of industrial customers of PG&E and Southern California Edison. They're CCA customers, they're bundled utility customers, they're direct access customers. Some have on-site renewable generation. What they share is the fact that their cost of power here in California is a significant component of their cost of manufacturing. And I want to make 3 points on behalf of CLECA. The first is that rates in California are already very high, much higher than our neighboring states. In December 2018, the average industrial electric rate was almost 12 cents per kilowatt hour. In Nevada, it was less than 5 cents per kilowatt hour. So rates are already high. We recognize, however, with the wildfires that we've had, rates are going to go up. But the costs that we're talking about are in the tens of billions of dollars. The mitigation plans for 2019 alone could reach over $3 billion for the 3 industrial utilities. That's just for 2019. That's going to be an annual, iterative, recurring cost that's imposed on ratepayers. The cost for the liabilities, as I'm sure you're aware, for 2017 and 2018 is over $30 billion. And what we do know is that there will be more wildfires. Hopefully the risk of catastrophic wildfires will be mitigated as we harden the system, as we undertake all these other efforts. But the costs are significant. They're in the tens of billions of dollars. And that brings me to my 3rd point, which is the ratepayers cannot bear these costs alone, given this context. We need to look beyond the utility ratepayers. We need to look to the utility shareholders. We need to look to insurance companies beyond the premium payers for the insurance companies, but to actually the insurance companies and look at their profits. Chair Peterman, I really appreciated your question about, looking at who is ultimately this risk being transferred to. And CLECA's greatest fear right now is that it's just all going to be transferred to the ratepayers, and that's untenable. I will supplement with written comments.
Thank you so much. Thank you, Ms. Sheriff. Next, we'll hear from Joan Anderson, Neil McCowan, and then Daniel Settlemyer. And then we'll be looking for some brief reactions and comments from our local government representatives. Thank you. Welcome. You, Mr. Anderson?
Oh, yes.
John?
I guess my handwriting isn't very good. John Anderson.
Okay. Nice to meet you as well.
Thank you. My name is John Anderson. I'm the Director of Forest Policy for Mendocino and Humboldt Redwood Company. We own 400,000 acres of timberland, and I came here today because I thought I wouldn't hear anything about managing fires before they get into residential areas. What better way to cut costs and keep it from getting there? And we have many obstacles in California as far as doing that. The timber harvest plan process to thin out trees, that's a $40,000, $50,000 permit. So we look at doing exemptions to that, and there are some in the state. We do have one right now called the Forest Fire Prevention Exemption that allows us to thin out trees without that expensive permit. That was upgraded a little bit under SB 901. However, it's limited to 300 acres. We have a goal in the state of treating 500,000 acres a year. So we're kind of hamstringing ourselves there. Also, the biomass energy industry needs support as well. We've got a lot of sub-commercial material. That's a great use for it. SB 515 going through the system right now allows those types of industries to get fuel from other areas besides just tier 1 and tier 2 areas. But then yesterday in the committee, that was what we wanted to do in that bill was allow them to get material from moderate, high, and very high fire hazard areas. They redlined out medium and high yesterday. So we're really standing in the way of ourselves here on a lot of this, and we have goals of increasing the pace and scale of forest management in California. So I would just ask the commission to support bills that are pro-forestry. We can keep fire on the ground if we manage it right. And being a past wildland firefighter, that's when you can get right up to the flames, put them out. You get a back way off once you have overdense forests and the flames are up in the treetops, and we have houses burning. So I'll put all this in writing, but ask you to support forest management bills that are going through the process.
Thank you, sir. Mr. McCowan. Hopefully I said your name, sir. Welcome. Please say it again for the record.
Neil McEwen.
McEwen.
I'm also a 2015 Butte Fire survivor. My family and I lost everything, and I thought that we were insured for full replacement value. And as it turned out, Wells Fargo got their money back on the mortgage, but there was nothing left for which to rebuild. We also reached a settlement with PG&E in November, a signed agreement. I have a wife and 2 children, 2 140-pound dogs, and we've been living in a fifth-wheel trailer for a long time. And we had signed this agreement with PG&E, and they never wrote the check. They also selectively wrote checks to people who had made similar settlement agreements, signed settlement agreements. And they selectively chose who they paid and who they didn't. And I can prove that. And I want to consider that the Insurance Institute for Business and Home Safety on their website clearly puts forward that their drive, that they've started using a rate the state system in which they choose the science that can shape codes. And they're using these codes to chase people out of the WUI. I personally cleared 4 acres around my property, and yet it still burned. I was cleared by CAL FIRE as having gone above and beyond clearing. And the way that the insurance institutes are influencing the codes that are being the counties are essentially forced to adopt are placing increased barriers for people to be able to rebuild and further limiting the availability of affordable housing and rebuilding capabilities.
Thank you, sir.
Thank you.
And then finally, our last public comment is from Daniel Settle. Welcome. I want to say we appreciate particularly hearing from all the wildfire victims. We know that the experiences you share with us are not unique to you, and they represent thousands of others. So thank you for taking the time today. Sir, welcome.
Thank you very much. My name is Dan Selmeyer, and I come to you as formerly a lifelong Coffey Park resident, now a volunteer firefighter in Petaluma, and a staff member of Marine Clean Energy, otherwise known as MCE. Like many of you here, my family lost our home in the 2017 North Bay fires, and we are still in the process of rebuilding. Doing so has been incredibly difficult, so in the hopes of helping those who have found themselves in a similar position, I'd like to share some information about MCE's Advanced Energy Rebuild NAPA program. MCE is the default provider for Napa County, is a default power provider for Napa County, and many of the customers we serve lost their homes in the 2017 fires. As part of MCE's commitment to our communities, we are offering rebates to supporting homeowners in rebuilding energy efficient and sustainable homes. Qualified homeowners are eligible for incentives up to $12,540, and this program is offered jointly by the Bay Area Air Quality Management District, MCE, and BayREM in partnership with Napa County, and is an enhancement to PG&E's longstanding California Advanced Loans program. If you are interested in learning more, there will be an informational workshop this Saturday, April 6th from 10 a.m. to 11:30 at the Napa Main Library. I'm also more than happy to act as a point of contact to provide informational handouts to anyone who has questions. I encourage anyone who would like to know more to come by and say hello. Thank you for your time.
Thank you very much. So we appreciate the participation of Supervisor Boren and Supervisor Gore and Pete Parkinson, and we asked them to give some insight into some of the costs of the communities have borne. Given the time, perhaps you can just share with us at least some of what you'd like to share, as well as what you'd like the commission to be thinking about in the weeks ahead, and then offline, we'd love to have a more focused conversation with you.
Thank you.
So Supervisor Gore, please begin.
I think we'll just hammer straight into it. First of all, call out to the fire survivors out here. You heard from a lot of them. They are our heroes, and that's not politics. That is going to hell and back with them, and honored to serve in always in every way, including my colleague to my left who lost her home in the Nuns fire. So my name is James Gore, County Supervisor. I'm also the chair of the California State Association of Counties, Resilient Counties Network, chair of the National Association of Counties, on the Resilient America Roundtable. None of that matters. What matters is that we have been in the efforts at the basic local level, regional level, state level to build resilience into our networks and to recover. So the thing to remember, just to set some context for all of this amazingness, is that what happened to us on October 8th and in the week that followed was not a wildfire, it was a windstorm, right? It was a catastrophic natural disaster event that really you could equate to Santa Ana winds in the south. They call them Diablo winds up here. So you're talking about 40 to 60 mile an hour winds on the fire lines, really 80 to 100 mile an hour on the peak, and a fire that, even though it was in our local hazard mitigation plan as saying this will happen again, and there was a footprint similar to this, it traveled that same distance from a fire that took days to get to the city of Santa Rosa. It took hours to get to the city of Santa Rosa. Great thing to remember about this is that as much as we're talking about the WUI, if you look at the Tubbs fire, if you look at the Camp Fire and the Carr Fire, all three of those went beyond the WUI straight into areas that would not be considered fire-prone areas because of these kinds of storms, wind events, fuel, and everything that we know is a part of it. I'm going to quickly go in and say 5,300 homes in Sonoma County were burnt down. Of those 5,300, 60% occupied by owners, 40% occupied by renters. Renters had 29% of renters had rental insurance. Of owner occupied, 91% had insurance. So you can do the math, like Jeff Krupke said, that equates to about 33% of the houses had no insurance whatsoever on their books. Yeah. So if you go even a step further, you talk about insurance and where we're at. The United Policyholders, which has been a prime and exceptional partner, and I want to thank Amy for being here today, on their 6-month survey and their 1-year survey with the North Bay Fire Victims Network, there's been a couple things that it showed. One is that 2/3 of the people who reported, 500 people reported to the 1 year, 800 people reported to the 6-month survey. Of that, 2/3 of the people underinsured by an average value of $317,000. So when you look at those numbers, what you realize is that there is a problem, that you can't just get into these memes and these big concepts about evil insurance or stupid consumers or this or that or whatever. as much as we'd like to sit and discuss all the different areas that we are advocating on for insurance reform and regulation, the biggest thing that I want to thank Dave Jones for being a champion of when he was in the position, and all of you, is transparency, accountability, accounting, audits. Let's go. Show people what they truly are insured to do. Because what happens when you get into a situation like this is you have certain companies that will make policy decisions like you asked for, and we have companies like Farmers where they said 100% of building, 100% of your contents without any inventory list, and we'll give you your ALE as a lump sum, and you get to use it for 2 years, 3 years, whatever. Others, what you would call it, is death by adjudication, right? So the adjusters come in, or death by adjustment. The adjusters come in from all throughout the country, exactimate all these others, so you do this. So the thing I want to tell you is 2 things. This is it. Number 1 is transparency on the insurance side. Number 2 is with respect to the utility, no relief, no resources without resilience. Go tour San Diego Gas and Electric like I and my colleagues did. See what happens when you don't just jump to it.
Come over here and tell me we're not here, someone from the facility, so I'm gonna ask you to wrap up.
Well, it's okay, we run the facility, so Darren will be a little.
You can say that.
It's nice to be the chair.
I mean, even if it's not true, I mean, I can just say it and see what happens. So once
I did my
again,
part, continue.
no, I mean, I'm at like 433, so no relief, no resources without resilience. The investment in resilience by the utility is paramount. When we went through last year the bloody dialogue and battle with us leading, even at the state level, inverse condemnation, a key there is do not look to privatize profits and socialize costs. I have no issue with paying higher rates if they include resilience as a part of it. I have an issue with having a system set up that separates those into the wrong kind of buckets. Thank you very much.
Thank you, sir. Supervisor Gordon.
Thank you. I'm Vice Chair of the Board of Supervisors, and yes, one of the fire survivors. There are a couple messages here. First of all, there were like, 200 fires that started that weekend all over California. There were 8 to 10 fires that started all over Sonoma County that weekend. I lost my house 2 nights later as the fires conjoined and came through a state park and then took out a stand of eucalyptus trees and my house. I loved living next to the state park until that night. When we talk about what we're doing with forest management and insurance, please look at the state resources, and that includes the state parks. They're significantly underfunded in dealing with vegetation management. I am so fortunate to represent 3 state parks in my district, and 2 of them sustained significant damage, as well as a number of our regional parks throughout the county. So we're abuzz with activity on vegetation management. We need more resources to create the fire safe councils and community preparedness that we're absolutely committed to do. On a personal note, since you are talking about insurance, yes, I'm exactly the case model for what the legal aid was talking about. We bought our home about 5 years ago in a active adult community, I would say. We are active adults even to this day. And very modest home, and found out with now our PhD in insurance, we were insured for about $500,000. We designed a home almost immediately, an estimate to rebuild of $1.86 million. 3.5 times what we're insured for, even though we purchased that policy less than 5 years before. Why didn't the insurance company come to us and say, we need to evaluate your home every couple of years, boost your coverage, put the riders in, put the code upgrades in, and we're not yet settled with Nationwide, and still having some issues on inventory of contents. Why doesn't every insurance company say you lost everything? We will give you the content coverage that was outlined in your policy. Why put these fire survivors through the pain and agony of trying to remember every single thing that they lost in their home and coming up with a value for items that are priceless? So, I think my message to you all is we absolutely need some insurance reform here. One department director had that update from the insurance company, settled within a week. The other department director with the same insurance company did not have that review. She's not sure how she's going to afford to rebuild, which she's committed to doing. So most of the folks in Sonoma County have not yet started the rebuilding process because they're still mired in insurance arguments and negotiations. Folks with resources hire brokers, attorneys, adjusters, and they get more than their value of the policy. Those without resources are struggling just like me. So we've organized all of our fire captains, neighborhood captains, every single one of them tell a very similar story for their, we've moved beyond grief and trauma to now going through the drudgery of negotiating with insurance, finding a builder and a design that we can afford to rebuild. Thank you so much for your time.
Thank you, Supervisor. Mr. Parkinson, you have the last word. Welcome.
That never happens, I'll tell you.
My
So what I want to try to do is just to connect the human dimension a little bit to the cost and finance issues that your commission is grappling with. My wife and my 9-year-old son and I lost our home in the Nuns Fire here in Sonoma County, just about a couple miles from Supervisor Gorin. But I've also have over 35 years of experience as a professional planner. I was the planning director here in Sonoma County until 2013, and I had the good fortune to be the planning manager in Santa Cruz County during the Loma Prieta earthquake in 1989. So we initially evacuated to my mother-in-law's house at the Journey's End Mobile Home Park, about a half a mile up the road here. So we evacuated Grandma too, and the mobile home largely burned down as a result of the Tubbs fire later that night. But I also consider us to be incredibly fortunate because we did not have the horrifying experiences that some of my neighbors did, of having to run out of your house with your house on fire already, of having to abandon your car and run for your life, literally, of having to cut through barbed wire and drive overland with a car full of kids because the roads are blocked by fallen trees and fire, and a neighbor just down the street from us who passed away in his home because he couldn't get out. In our neighborhood, we had 130 homes before the fire, 92 of them burned. Only a little over a third of those are under construction right now, which means that about 2/3 of them are not under construction. And the trauma as a result of the wildfire experience is a major contributor to that. Now, underinsurance and the high cost of construction are also a big deal as well. But that trauma is palpable when you talk to people about it. And I think that there's at least 25% of my neighbors who will not be coming back to our neighborhood as a result of that. So how does that fit in with the work that you guys are doing here? Let me try to draw a couple of specific examples. One is that when you have a...
Sir, if you get the high points, you know how we're doing on time.
I do, but I work so hard.
Just to note, I think we are being evicted. Looks like.
Keep talking.
Why don't I just submit it in writing? I can see you guys have got so much to work on here.
And Lasco, they can come in. Yeah, go ahead.
Please, go ahead.
3 minutes.
Let me just hit one point here, which has to do with...
No big deal. What are we talking about?
With empowering individual property owners to take effective steps to reduce their own risk. We hear a lot about forest management and fire breaks, and we've been learning a lot here in Sonoma County since the fires. This was not a forest fire per se, it was a structure fire, largely in the WUI areas, but certainly not exclusively. And we need to stop making things worse by continuing to approve new development in high fire hazard areas, but we also need to empower and incentivize individual homeowners to do what they can to harden their homes, just like the fellow from the Earthquake Authority was talking about this morning. The advice that we get consistently from wildfire behavior experts is you start at the house and you move outward. That is the most effective thing to do. So,
good job.
Thank you all.
Thank
Appreciate
you
your
all.
patience. See you eventually April 29th. Please evacuate the room as quickly as possible. We are adjourned.